And here are your top stories. China imports plunge as concerns grow about the nation's economy. But Asia stocks, they rise after export growth tops estimates. And as we await tomorrow's US CPI data, Fed reports highlight growing credit risks and funding concerns, with demand for business loans weakening. Plus, Credit Suisse CEO Ulrich Körner will join the UBS Group Executive Board as the Swiss lender announces a broad management overhaul following the takeover. Let's check in on these futures then. We'll get meal details, of course, on the Credit Suisse UBS story just in the next few minutes. Across these futures pointing lower by about 0.1%. You saw a little modest upside, particularly for the NASDAQ yesterday. European markets closing modestly in the green. The UK was closed for a bank holiday. We'll check in on the FTSE 100. We flagged the fact that loan data, the demand for loans at the US falling to the lowest level since around 2009. We look ahead to CPI tomorrow. The likes of Marko Kolanovic over at JP Morgan saying there is worse to come for these equity markets in the second half of the year. The risks are not yet being fully priced into these markets, is the line from Kolanovic. You're flat across the FTSE 100 after the close yesterday. Of course, no trading in the UK for that bank holiday. The Spanish IBEX currently down 0.1%, dropping, 13 points. Over in France, the CAC 40 is off by a little bit more, down 0.3%. Ollie Rehn over at Philip Lane, I should say, over at the ECB, the chief economist there, saying that the momentum around inflation from the Eurozone continues. He does, though, see disinflation in the second half of the year. Of course, the ECB moderating their rate hikes by 25 basis points in their last move. Let's switch it over and see how things are shaping up cross-asset then. The CPI print, the data point of the week for the US, that tomorrow. Futures stateside then pointing to losses of about 0.1%. Interesting that Kolanovic also pointed to the narrowness of the rally that we've seen so far for the S&P, the narrowest run-up that we've seen since about the 1990s, that posing a risk, at least in his mind. Euro-dollar 109, not all the movement for the single currency. The 2-year is seeing a little bit of money moving back into US Treasuries, just at the margin, 2 basis point, 3 basis point move there, 397 on the 2-year at the front end. Brent, $76 a barrel, currently down 0.8%. We've had Saudi Aramco earnings coming through. We're going to break down the oil store for you in the second half of this show. Now, let's get back to some calls around the Fed then. Goldman Sachs strategists have joined those at Barclays in advising customers that the Fed will be less aggressive in cutting interest rates this year than markets are pricing. Let's bring in Paul Dobson then, Bloomberg's executive editor for Asia markets. Paul, what do you make then of the calls from Goldman Sachs and Barclays that it's time to fade the pricing of those cuts coming through from the Fed? At least around the swaps traders, they're pricing in about 70 basis points of cuts by the year end.
Yeah, interesting timing, isn't it, for them to come out and say that now? We've obviously just had the Fed meeting, what might be the last hike of the cycle. We heard from Powell, he's still pretty resolute in the need to keep interest rates higher for longer. And we've had some more stiffening in terms of the jobs data as well. So, the investment banks are essentially telling us to believe the Fed, which is something that the markets have not been doing for a very long time. We've priced, as you said, about 2 cuts and then some already through to year end, but we've been priced more aggressively than that already earlier in this year. So, that is the big debate for everything. And really the framing for the entire market at the moment is how soon will the Fed need to cut? How aggressive will it need to be on that as well? I think, and for that, the CPI data that we're going to get tomorrow from the US is going to be really crucial in helping to formulate those views.
Yeah, that debate is very much live, isn't it? The debt ceiling, also front and centre for us today, Paul, with a meeting that's going to be happening, we expect, in the White House. We have some sound from Bill Gross, of course, the former CIO at PIMCO, and this was his view. Let's take a listen.
I think it's ridiculous. It's always resolved, and not that it's 100% chance, but I think it gets resolved. I would suggest for those that are less concerned, similar to myself, that they buy a 1 month, 2 month Treasury bill at a much higher rate than they get with a longer term Treasury bill.
That's the call then from Bill Gross. Buy short-dated T-bills. This will ultimately be resolved. Paul, what is your assessment of the market risks from this event?
Yeah, well, as Bill Gross said, it's not 100% guaranteed that it will be resolved. And that's what everybody has to bear in mind, right? And the longer that the standoff continues, we're going to learn a lot about how entrenched those positions are later today, most likely. The longer that standoff continues, the more of a risk it becomes. And for certain types of investors, it's just not possible to hold on to those bills with that risk out there, which is why it creates that kind of disconnect or that disjointed structure across the curve for the short-term interest rates. And, so for somebody like Bill Gross, who is able to have that flexibility, able to take on that extra little bit of risk, and even if it doesn't get resolved, knows that at some point the US will honor its debts. Pretty much certainly. It's not too much of a risk for him to take it on, but there are kind of other investment classes where that's not possible. It creates that opportunity for those that want to take the risk. I think more importantly for global markets at the moment, still fairly complacent on the whole thing. Okay, so we've seen some raising of gold prices. Maybe there's some hedging and some uncertainty there, and a little bit of weakness in the dollar, maybe relative to yield spreads. But at the moment, nothing too dramatically priced in to global markets. The closer we get to that deadline, the more that tension might start to build, the more we'll see implied volatility start to rise, and the more that people will start to worry. And as Bill Gross would say, we've been through this before, we've seen this movie before. Why would they think that it will turn out any differently this time? Well, if it's not 100% guaranteed, then there's always that risk that there will be an accident.
And you're seeing a little bit of complacency. Gold, as you say, above 2,000 per Troy ounce, 109 in euro dollar. So just unpacking your call, or at least your views, Paul, your sense in terms of the currency impacts of some of these risks. Euro dollar at 109. Do you have a view on the single currency? How are markets thinking about the FX effects?
Yeah, so not talking necessarily about the debt ceiling per se, but looking a little bit more long term. I think that the favor trade for the last few months has been long euro dollar, but it just hasn't been able to cross that threshold and get to those new highs to push beyond the sort of 111 zone for euro dollar. And what would it take? Either lower US interest rates, higher European yields, or somewhere in between. I think the ECB slowing the pace, but trying to sound hawkish still. Didn't do the euro any favors in that respect. What it really needs is for the ECB to show, show that it's going to continue going. And some of those calls for the ECB hiking to outlast the Fed's pace are starting to fall off as well. So people are a little bit less certain on that. Meanwhile, the economy on both sides of the Atlantic is sort of mixed in terms of the data that we're seeing at the moment. So there's plenty of reasons to start to lose interest in this, or maybe look elsewhere, maybe start to express it in different ways. Have a look at the yen, which could be more interesting if you're looking across G3 FX for where there might be more momentum at the moment. We're seeing a little bit stuck euro dollar. I'm sure when we do break out of it, finally it will be a big move in one way or the other, but it's very difficult to tell which direction that's going to be right now.
Meanwhile, China, mainland markets, Hong Kong selling off today as well. Is this all about the export-import data, Paul?
Yeah, no, I don't think not all about it, although that's certainly a matter for some concern. And certainly the unevenness of the Chinese recovery has been a reason that people are, hesitant. It certainly isn't that kind of recovery that brings the rest of the world along with it, that really helps the neighboring countries around China. That's not what we're seeing this time. It's not manufacturing driven. And we know that the global demand picture isn't that rosy, so China can't just export like crazy and make up for its growth that way. So there is that cause for doubt. But we've also seen some very strange things going on under the surface in the past couple of days. A big rally in banks yesterday, a big rally spreading to some securities companies and other state-owned enterprises at the start of today. And, we were even saying in our stories earlier, a lot of warnings out there. Beware of frothiness, beware of excessive moves. And lo and behold, everything snapped back this afternoon as well. So whatever that was, that sort of pop and fizzle and slide again, we're back to more normal levels, but it's kind of, like a balloon getting blown up and let out again at the moment. Another raspberry blown over the Chinese stock markets.
You're tying in the balloon there with a little bit of controversy around the geopolitics. Really excellent analysis and context, of course, Paul Dobson, across all of these market themes that are front and centre for us this morning. Thank you. We have some breaking lines for Saudi Aramco, which, of course, came out with its earnings a little over 30 minutes ago or so. But the importance was the dividend announcement. Saudi Aramco rising around 7%, a little over 7%. After that dividend announcement then. That was a special dividend, at least a performance-linked dividend. In terms of what came through, performance-linked dividends and the report around the earnings, of course, from that oil major. We're going to be more on this story in the second half of this show with an analyst in the oil space, the implications, particularly around its capex spending and looking ahead to OPEC Plus as well. We also have some lines coming through from the ECB, the European Central Bank. Rate hiking may not be finished in July. That is coming through from the member of the European Central Bank, the governing board member, Kazaks. A couple of other comments coming through from him then. Bets on spring 2024 ECB cuts are significantly premature. Kazaks also saying it's not impossible for the ECB to hike or pause as the Fed cuts. Checking in on euro dollar for you, 109, still down about 0.1%. Not a lot of movement on the back of that, but that's the redhead. The ECB rate hiking may not be finished in July. The warning there from Kazaks. Let's get to the China story then, the details around the trade data and what is happening on the ground in terms of a crackdown, particularly around the collection of data by some companies. China launching a nationwide anti-spy crackdown on consulting firms. According to state media, Beijing is tightening foreign access to sensitive information amid growing tensions with the US. Let's bring in Bloomberg's Jill Desis then. Jill, the clampdown on data access, to what extent is this indicative of broader concerns about information flow in China? How much of this is led by the Ministry of State Security?
Yes, certainly. Well, I think that, regardless of whether it's public or private, clampdown on data access in China, it's certainly indicative of a growing issue that we've seen. I mean, just look in recent weeks, we saw the domestic data provider Wind restrict access to information for overseas clients. We've also seen, at least from the government side, a crackdown investigation into U.S. consultancy Bain & Company and its operations in China. So certainly that spells some kind of indication that there's this broader chilling effect, more investigations, more requirements for restrictions there. But we've also seen, I think just over the last year or so, sort of a tightening up in data access within China. Now, you can't necessarily say, especially when it comes to some of those private firms, what exactly their motivation is for restricting data, whether it's, advertent, sort of overt measures taken by the government to say, don't release this information, or whether there's more private concerns there. We can't necessarily say, but still, I mean, if you look across the country in terms of academic publications that have restricted access to foreign data, we're certainly seeing some of that. I mean, even just look at what the WHO has told China about trying to cooperate more on COVID data over the last couple of years. We're not getting as much sort of insight into China's own COVID data there. So it's really sort of a broad measure of different types of data points that are making it very difficult to have insight into what's happening in China.
Indeed. Jill Desis, thank you, out of Hong Kong on this anti-spy crackdown, implicating, of course, or at least impacting both domestic firms and foreign firms as well. Broader implications there, longer term, arguably about the appetite to invest in China from those foreign firms. Coming up, UBS has announced a reshuffle of its leadership after the emergency takeover of Credit Suisse. Who stays and who goes? We have the details next. This is Bloomberg.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer, Wednesday on Bloomberg.
DOJ or other authorities
could face bigger challenges.
Next. Was going to keep bringing World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg.
Welcome back to the Open. We are 15 minutes into the European trading day. Losses of around 0.2% across the benchmark. Futures in the US also now pointing lower. S&P E-minis down by 0.2 as well as the Nasdaq futures. Euro dollar currently 110. We are 109, I should say, close to 110. We had a line coming through from the hawkish member of the ECB's governing board, Kazakhs, warning that we should not assume that the ECB will be done with its hiking in July. Meanwhile, you have the likes of Barclays and Goldman Sachs saying we should be fading the pricing in of cuts, basically pushing back against the idea that we're going to get significant cuts from the Fed by the end of the year. Let's get back to the banking crisis, or at least the banking situation in Europe. It's not a crisis. We're talking, of course, about the merger and the continuing details around UBS and Credit Suisse. UBS is appointing Todd Tuckner as Chief Financial Officer, replacing Sarah Youngwood as part of the management overhaul following the takeover of Credit Suisse. When the deal closes, the bank says Credit Suisse CEO Ulrich Görner will become a member of the UBS executive board. So some name changes, or at least some shuffling on the decks there of UBS, bringing on board and reshaping some of the management team, giving us a flavour as to what happens in the weeks and months ahead as, of course, UBS works to absorb this bank. Tom Metcalf, of course, from our finance team, has more of the details. Tom, what stood out for you? What does it tell us about how much progress is being made? Some of the name changes, what kind of signals do we get from this?
Yeah, I think there's two things. First of all, that Tuckner being brought in to replace Youngwood as CFO. I think really the message there is what we've been hearing from Sergio Emotti all along, is very complex deal, and they'll be looking for sort of almost UBS lifers to take it forward. So that move makes quite a lot of sense, right? You've had Tuckner at UBS, I think, since the early 2000s, so he knows that business inside out, and presumably they're looking just for that real grip on the kind of the way UBS works. And then on the other side of the coin, it's interesting, keeping the Credit Suisse CEO around. That again makes a lot of sense. Who knows the business better than him? Presumably no one. So you can kind of see the thought process behind that. And then the other thing that jumped out for me from the statement was Iqbal Khan, named, as we know, staying there as head of wealth, but one of the big power players in UBS, and that kind of sets up the business going forward in terms of who are the movers and shakers.
Yeah, a really big power player, isn't he, in terms of the wealth management part of the business. Did we get any more details in terms of timeline for this merger, this acquisition? Any more details in terms of parts of the business they may be looking to spin off or sell off, or was this all about name changes?
So there's no great news specifics. I mean, I think the message is the same. They're trying to do this as quickly as they can. We've had warnings in the last few weeks. Credit Suisse is seeing an exodus of staff, so it's in UBS's interest to get this settled, add a bit of stability, and hopefully kind of set the ship on the right course. So that was one thing. And then on the spin-offs and stuff, probably the best line in there was about the Swiss unit. As we know, they're basically saying we're considering all options. So, it brings up, might there be an IPO? Might the Swiss business, as we know, UBS wants to do, be kept, kept as it is, basically, but effectively no real new guidance.
Okay, all options still available for the Swiss unit of Credit Suisse, which of course is seen as something of a prize for the UBS team. Tom Metcalf, thank you very much indeed for the latest in terms of some of the management changes at the top of the tree there at UBS as it takes on Credit Suisse and what it tells us about that project going forward. For the team at UBS, thank you, Tom Metcalf from our finance team. Let's get the Bloomberg Business Flash now with Sarah Warhols. Sarah.
Thank you, Tom. China's export growth slowed last month while imports plummeted, adding to pressures on its economic recovery. According to official data, imports dropped almost 8% in the year to April, much worse than the median projection of 0.2% decline. Exports grew 8.5% over the same period, partly due to a favorable comparison with last year, when much of the country was under lockdown. Bloomberg's learned that Goldman Sachs has agreed to pay $215 million to end a long-running class action lawsuit that accused it of systemically underpaying women. According to a joint statement with the plaintiff's lawyers, the bank struck a deal with the group, which represented about 2,800 women alleging discrimination in pay and promotions. The deal to settle the dispute comes weeks before a trial was due to begin. PayPal shares fell in extended trading after the company lowered its adjusted operating margin forecast. The payments giant says it now expects the margin to grow about 100 basis points this year, lower than its earliest forecast of 125 basis points. The weak guidance overshadowed PayPal's first quarter earnings beat and its higher full-year profit forecast. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Tom.
Sarah Halls in Dubai, thank you. We're getting live pictures now of the Russian president on the Victory Day parade, the World War II Victory Day parade that is going ahead in Red Square. There you can see the live pictures from, of course, the Russian capital. Amid, of course, security concerns. We had that drone attack that happened, of course, on the 3rd of May. The Russians blaming that on the Ukrainians. The drone attack targeting the Kremlin. The Ukrainians, of course, have pushed back and denied that they had any involvement. The Russian president will be speaking. You can see taking a pause there. And this, for and in Putin's Russia, is, of course, a major event. But we do know a number of parades across the country have been scaled back or cancelled because of security concerns. And this, of course, coming at a time when Russian troops are bracing for a potential spring offensive from Ukraine, from Ukrainian forces. So we'll keep across these live pictures and the speech from the Russian President Vladimir Putin, which is expected imminently. Right, coming up, Turkey's main opposition leader accuses President Erdogan of covering up the country's finances. The importance ahead of the elections, of course. That story is next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open. 23 minutes into the European trading day. Losses of a little under 0.2% across the European benchmark as we look ahead, of course, to CPI, that print out on Wednesday out of the US. Talking the US futures currently down about 0.1% on the S&P E-minis here in Europe. Top of the list in terms of your sectors, travel and leisure gaining 0.4%. Bottom of the state is real estate. And we can dive into a couple of the individual names where property is in focus, particularly in Sweden. SBB then, the Swedish real estate and developer, they're cutting or at least postponing its dividend. This after its ratings were cut by S&P yesterday. The stock slumped about 20% yesterday. Currently, SBB, as you can see, down a little over 5%. Saudi Aramco coming in with a very different story when it comes to the dividends. An additional dividend, so boosting that share price, currently 3.7% gain there. That coming out after its earnings. And Daimler Truck, this was a beat in terms of the earnings picture on the back of improved supply chains and demand for the first quarter, but the stock down 3.6% for Daimler Truck. Now to geopolitics and the politics of Turkey and the economy there. Turkey's main opposition leader has accused President Erdogan and the government of covering up the true state of the economy and the country's finances. This ahead of key elections later this week. Joining me now is Bloomberg's Turkey Bureau Chief, Ona Ant. Ona, what do we know then about these accusations?
Erdogan's key challenger, Kemal Kılıçdaroğlu, spoke to Bloomberg a couple of days ago in an interview, and he basically said that he believes the Turkish government is concealing the truth about the economy. It's a very broad accusation, but at the heart of it is a very simple argument. It's the fact that he believes the government, well, official numbers on economy, be it inflation or budget deficit, cannot be trusted until his team takes a hard look at it after Sunday's election, should he defeat Erdogan and becomes Turkey's next president. He's also frustrated about the Turkish stock market. He says it has turned into a place where small investors are robbed of their savings, and he's also pledging a probe into the stock market, again, should he get elected as Turkey's next president on this Sunday.
And it is, of course, the parliamentary election this Sunday, as you said. What is in focus then for the voters, Ona?
Well, it's both parliamentary and presidential elections, and for Turkey's 64 million voters, I think the elections are more about economy than anything else. The country is going through its worst cost of living crisis in at least a generation, definitely the largest one since Erdogan came to power just over 2 decades ago. Inflation topped 85% nationwide last year before it cooled down a little bit on base effects. But many people blame the surge in consumer prices on one thing and one thing only, and that's Erdogan's unorthodox ideas on economy.
Okay, Bloomberg's Ona Ant, thank you very much indeed with the preview. Coming up, Saudi Aramco shares jump after it announces a new performance-based dividend. We get the details next. This is Bloomberg.
relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. China imports plunge as concerns grow about the nation's economy. But Asia stocks rise after export growth tops estimates. And as we await tomorrow's US CPI data, the Fed reports highlight growing credit risks and funding concerns, with demand for business loans weakening. Plus, Credit Suisse CEO Ulrich Körner will join the UBS Group Executive Board as the Swiss lender announces a broad management overhaul following the takeover. We check in on these markets then, 30 minutes into the trading session. Comments from one of the hawks at the ECB saying, Mr. Kazek saying, do not bet on the ECB necessarily pausing in terms of its rate trajectory and further hikes come July. Across the European benchmark, you're seeing losses of 0.3%, continuing to get a trickle through of earnings, of course, and the read across around the recession risks coming from the US and what role China has to play in that. That surprising drop in imports, the extent to which China is going to be propelling this global economy really put into question with the trade data that's come out this morning. European benchmark currently down 0.2%. The DAX in Germany is unchanged. Here in the FTSE, we're reopening after that bank holiday of yesterday, currently flat, just down by 1 point. Across your sectors, let's flip it over. The last time I looked, it was real estate that was doing the heavy bleed at the bottom of the list, and there it is, down 1.5%. SBB, a real estate company in Sweden, really interesting in terms of the plight of Swedish real estate, whether or not it's a canary in the coal mine for the broader real estate market across Europe. Currently, that's the drag there across that sector, down 1.5%. They've scrapped or at least postponed and suspended their dividend on the challenges there. Top of the list, travel and leisure, up 0.5%. Autos and parts also squeaking out some gains, up 0.3%. Let's get back to the oil and energy story and the centrality of Saudi Aramco, with the shares there jumping after that company said it will pay a performance-linked dividend, potentially boosting payouts for the Saudi government by billions of dollars. This comes as the world's largest energy company reported operating profit that missed estimates. For more, I'm joined by Crystal Energy founder and CEO, Carol Nakle. Carol, good morning. Thanks for joining us. Your take then on the earnings that came in with a miss, but the dividend that is propelling this stock price this morning.
Good morning. Well, the results kind of were expected because we saw a decline on a year-on-year quarterly basis by 19% in the earnings, but in the net income, which is almost the same as a decline that we saw in oil prices over the same period by comparison. So in that respect, this did not come as a surprise. Still, despite the decline, these are pretty robust and interesting results that outshadow the rest of the industry of many other industries. So we should not see the decline as a weakness. It's a weakness in oil prices, but still financially, Aramco is pretty healthy. In terms of dividends, of course, their main shareholder remains the Saudi government. They reported a budget deficit in the first quarter of this year, and therefore additional dividends, whether you call them performer-based or just normal dividends, is something to be welcomed by the Saudi government.
Helps fill out those coffers, doesn't it? At arguably a bit of a challenging time for the Saudi government. You talk about the robust results then. The stock is trading at a premium to its peers. Is it still justified?
I think so. I mean, we're talking about here the largest oil producing and oil exporting company in the world. It's not just in terms of volume, but also the cost of production. So, and look, oil prices, even though they have softened significantly compared to last year, for example, they are still in pretty healthy levels. A little bit less than what the Saudi government needs to balance its budget, but they are not low. So in this respect, yes, it is financially a robust company. And don't forget their low-cost production, their low carbon intensity, which means they are not going to go anywhere anytime soon, despite the climate change agenda.
Did we get any clarity in terms of their CapEx plans, whether that's upstream or downstream? Do they still have the liquidity then? It sounds like they do, to continue spending. Any sense in terms of what that means for production going forward for Saudi Aramco?
Absolutely. And don't forget that they announced very ambitious capital expenditures, and which is going to be the highest in the company's history, because they have the target of expanding production capacity to 13 million barrels a day by 2027. That is for oil. But also Saudi Arabia wants to become a net exporter of natural gas by 2030, and they want to double their gas production. So also they are going big on that, and they are expanding downstream with their petrochemicals. So they do have the money to support these kind of plans. And as I said earlier, they are in a strong and healthy financial situation.
Brent trading at $76 a barrel in the session today, down 1%. We can probably tie that to the data coming out of China, Carol, and we want to get your views on that shortly. But given that we've seen downside, 40%? Oil prices come off about 40% since June of last year. Are we looking at kind of sub $70 oil, or do we hold at these kind of levels?
Look, you can expect prices to go in any direction, right? Because the main factors for this year are, and it's the same thing as last year, have been the economic outlook. But many put lots of expectations, high expectations on Chinese recovery, post-COVID, abandonment of COVID zero policies. However, we're seeing that the Chinese recovery is happening much slower than previously expected. And that is adding to the gloomy sentiment prevailing in markets. But don't forget, it's not just about the demand. The demand is an important factor and actually much less understood than supply. But we also forget that supply responds to higher prices that we saw last year, and more supply is coming to the market. So there's no shortage of supply. And with OPEC cutting production, OPEC plus cutting production, voluntary last year and this year in April, the surprise voluntary cuts announced this in April, also build spare capacity. When you have significant spare capacity in the market, that also creates a mood of détente or relaxation or a sense of comfort in the market that puts downward pressure on prices.
And we have that OPEC Plus meeting. It's now penciled in for early June, Carol. Do you expect them to cut again?
I mean, you can't rule anything out, but the problem is that you end up in this vicious circle. The more you cut, the more spare capacity you build. Now, that is good to achieve market stability, especially in the light of continuous geopolitical tension, which can still create spikes in the market, but that at the same time creates more safety margin in the market and avoids this kind of upward pressure on prices. Because last year we were reminded over and over again that prices would continue to be in the three-digit area. People were pointing at the thin spare capacity, but with OPEC plus cutting production, we're going to see that spare capacity being rebuilt, and that can put downward pressure on prices, everything else being the same, of course.
Okay, Crystal Energy founder and CEO Carol Nakali there on the Saudi Aramco results, and a little view in terms of how things may shape up around pricing for oil more broadly in the weeks and months ahead. Thank you. Coming up, security concerns cast a shadow then on Victory Day celebrations in Russia. We bring you the latest from Moscow. That story is next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I don't think there's enough real growth for everything to work.
Our expectation for actually GDP growth is just above 1% for this year, but pretty much a flat 2024. And that is concerning.
The UK is showing tremendous resilience. It's a very stable position for us in the UK bank at the moment.
In Australia, we're taking a bit longer to get back to the inflation target than is the case in some other countries.
What we see in Europe, we basically qualify it economically as look-through, yeah? So we don't see a recession coming. We basically see some growth, even if it can be a bit sluggish.
Okay, bad news for the UK from this week's MLive Pulse survey focused on the world's wealthiest economies ahead of a G7 finance ministers meeting this week. To dive deeper into the survey, let's bring in Bloomberg senior reporter John Stepek. John, what did the survey tell us then about sentiment, investor sentiment towards the beleaguered UK?
Well, I mean, I think you've summed it up there. Sentiment's in the gutter. So we asked basically which G7 economy would see the worst decline in Standard 11 this year. And the UK was by far and away the highest as far as our readers were concerned. And that's Standard 11 in terms of real wages. So they expect real wages in the UK to drop further than anywhere else. I think one of the interesting things about this is the UK is actually doing significantly better than was believed to be the case like just 9 months ago. I mean, 9 months ago, everyone was saying we're going to be in a recession. The Bank of England was talking about how it would actually be the longest recession in pretty much living memory. And actually, we've got to this point, kind of middle of 2023, and there's no sign of recession at all. We've got kind of slightly mediocre growth. Real wages are falling. Yeah. Wage rises are much lower than inflation is. But overall, it's nowhere near as bad as it was just 9 months ago. So it's interesting that the sense of gloom just hasn't gone away. The cost of living crisis is clearly very, very much front of mind. And I suppose we saw that reflected in the local election results last week as well. There's a real sense of discontent.
And we hear from, to your point around the stronger than expected data, what, unemployment is still kind of sub 4%, something like that for the UK? Yeah. Noel Quinn, head of HSBC, saying he's pretty confident about the UK's prospects. What is it telling us? Is that sentiment impacting investor flows into the UK?
Oh, I think absolutely. I mean, there's still been money flooding out of the UK. And whenever we asked the readers, we sort of trapped them in a room and said, you can invest in the FTSE 100, the 250, gilts, or residential housing. Now, I think lots of people will be either appalled or very pleased to hear that no one went for residential housing. So house prices are, probably still going to come down this year. But the FTSE 100 was the most popular one. And what that kind of says to me is that you gave people a choice of UK assets to invest in.
And they chose the one. Assets.
Exactly. Yeah. It's not invested in the UK. It's exposed to overseas markets. So that is, again, it sort of reflects the overall tone of gloom. The other interesting thing actually was, though, that professionals also were somewhat more positive on gilts than private investors. Although, again, that's kind of double-edged. It either reflects the fact that they think that, well, at least you get a yield on a gilt. So, it's better getting that than nothing. And also perhaps reflects the fact that maybe they think interest rates will come down, which could be because they think inflation's going to drop, but also maybe because they think there's going to be a recession before the end of the year.
Well, let's see. We expect another hike this week, don't we, from the BOE?
Oh, absolutely.
Give us the light on the horizon then. Is there any glimmers of hope, John?
Well, I mean, I suppose there's 2 points I've made. One is that this is just a survey. Much as I have the utmost respect and love for my readers, they might get things wrong like everyone else. And this actual level of gloom might reflect that there's an opportunity in an unloved market like the UK. The second thing would be the inflation rate is going to fall hard this month when we get the next CPI figures in for April. That's purely because of base effects, but it will drop the rate to between about 7 and 8%, and that will look a lot better than the double-digit inflation we've got just now. So if nothing else, it might make people start thinking maybe there is a kind of light at the end of this tunnel.
We all have a lot of love and respect for your readers, John.
Well,
John Steppick, thank you very much indeed, of course, with a wonderful newsletter, and our senior reporter, of course, working through that MLive survey on the doldrums of the UK, but maybe a little bit of light at the end of the tunnel, as pitched there by John. Right, let's get the Bloomberg First Word News now with Sarah Hall. Sarah.
Thank you, Tom. China's export growth slowed last month, while imports plummeted, adding to pressures on its economic recovery. According to official data, imports dropped almost 8% in the year to April, much worse than the median projection of a 0.2% decline. Exports grew 8.5% over the same period, partly due to a favourable comparison with last year, when much of the country was under lockdown. Canada has expelled a Chinese diplomat in a move that risks a backlash from Beijing. The Canadian Finance Ministry says it's ordered Zhao Wei to leave, accusing him of interfering in the country's internal affairs. According to Canadian media, Zhao had been looking into penalising conservative lawmaker Michael Chong over his positions on Beijing. China has launched a nationwide anti-spy crackdown on consulting firms. According to state media, Beijing is tightening foreign access to sensitive information amid growing tensions with the US. It says a local branch of consulting firm Cap Vision has already been searched, with a number of other foreign firms also investigated in recent weeks. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Tom.
Sarah Halls in Dubai, thank you. Now let's get to what's happening on the ground in Moscow. President Putin has spoken at today's Victory Day parade in Moscow's Red Square. The annual event commemorates victory over Nazi Germany in World War II. The Russian president claimed, quote, "A real war has been unleashed against his country," a reference to the war in Ukraine. Johnny Mowers, Bloomberg's senior government and politics reporter, Bill Ferris. Bill, what is your assessment of what we've been hearing then from Vladimir Putin in this speech? What stands out?
Well, it was a very brief speech on this holiday. As you mentioned, he said that a war has been unleashed on Russia. He said Russia is under attack by Western globalist elites. That has been the pitch he's made to his countrymen since early in this conflict. And of course, there's been a lot of restrictions on media reporting within Russia. So that is really a message that many Russians, that's the only message many Russians have heard since the very beginning here. It was a subdued holiday in many cities and regions of Russia. These annual festivities were canceled for national security reasons. And of course, just a week ago, there were these drones that appeared to have been exploded near the Kremlin. So all of that overshadowing what is traditionally kind of a very nationalist day for President Putin. The parades are continuing, of course, but it does have it has a different there's a different atmosphere to it this year, more than a year into the Ukraine conflict.
Yeah, indeed. And it's not normally just focused on Moscow. Normally there are parades and kind of celebrations marking this across the country. And we've been hearing that some of those have been scaled back.
Yeah, at least 24 cities and regions, all the way out to Siberia, have canceled these celebrations today. Some are saying just for security reasons after, you have seen drone attacks that Russia has blamed on Ukraine, hitting various parts of Russia. You've also had some car bombs in recent weeks or recent months that have targeted pro-war bloggers, people like that. Ukraine has denied involvement in those, but there have been security concerns that have been bringing the war a little bit closer to everyday Russians.
And what is the situation, Bill, on the ground in Ukraine? We're hearing a lot about the potential spring offensive. Do we know what is expected in the coming weeks? Do we have any more of a steer on how things are likely to develop on the ground in Ukraine?
Well, just a few months ago, we were talking about an expected Russian offensive. That never really materialized. The Ukrainians have been replenished over the winter and the early spring by their Western allies. Now the expectation is that Ukraine will be launching an offensive to try to retake some of this territory that Russia took in those early days and weeks of the war back in early 2022.
Okay, Bloomberg's Bill Ferry's on those commemorations, that event, and the speech by Vladimir Putin in Red Square in Moscow. You can continue to see those live pictures, of course. Now, coming up, President Biden and congressional leaders meet today to try to break the deadlock on the U.S. debt ceiling. That is next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, 53 minutes into the European trading day, and the sentiment is turning a little bit more negative across these European equities, down 0.3%. You have a couple of sectors that are in the green, travel and leisure, but not by much, 0.3%. At the bottom of the list, real estate, thanks to what's happening in Sweden, currently down close to 2%. Energy, utilities also taking a hit, and futures in the US, the S&P E-minis pointing lower by 0.2%. The debt ceiling in focus for us today, and that is a part of the risk that the markets are trying to grapple with. Senate Republican leader Mitch McConnell has said that he will not come to Joe Biden's rescue on the debt limit by breaking a partisan deadlock. The president and congressional leaders are scheduled to meet today as a catastrophic US default potentially looms on the horizon. Joining us for the details and a preview of that meeting is Bloomberg's Bruce Einhorn. Bruce, what is Mitch McConnell saying then about the chances of a deal?
Well, what Mitch McConnell is saying is that if there's going to be a deal, it's not going to go through him, which makes sense given that the real action is on the Republican side in the House, because that's where the Republicans have control. So Mitch McConnell is saying that President Biden has to make a deal with House Speaker Kevin McCarthy. In an interview with Bloomberg News, McConnell said that he's talked to the president privately and said just that Mitch McConnell himself doesn't have anything up his sleeve. He doesn't have any solution here. It's going to be something that the president and the speaker are going to have to work on. That said, there's one bit of good news that came out of the interview with Mitch McConnell. He did say that he does not think that there's going to be a default. In fact, he said that the important thing to say is there will be no default. It will not happen ever, won't happen this time. So pretty emphatic that the two sides will eventually come to some sort of a solution. What that solution might be, he's not letting on.
Is one of the solutions potentially, Bruce, and to what extent is this being discussed in the halls of power in Washington, one of the solutions potentially a kind of muddying of the waters, a fudge, a short-term agreement to at least kind of kick this into the long grass?
Yes, actually, that is something that is being considered. It's been talked about increasingly over the last week or so. Most recently, Republican Senator Bill Cassidy from Louisiana told Bloomberg yesterday that this is something that he's open to as well, having a short-term extension of the debt ceiling, which would at least give the two sides more time to work on a deal. Of course, a short-term extension doesn't really accomplish too much if the two sides are still unwilling to budge, but at least it gives them more time, because one of the big issues at the moment is that most people thought that the X date when there would really have to be a deal or else the U.S. would go into default would come sometime over the summer, maybe even into the fall, when Janet Yellen announced recently that it could come as early as June 1st. That really caught a lot of people by surprise. And so the possibility of having an extension, which would at least give more time to work something out, is something that a lot of people are thinking of as a real possibility here.
Okay, Bruce Einhorn with the look ahead to that really important meeting later today in the US around the debt ceiling. Thank you. That is it for the European market open. Surveillance is early, it's up next as markets turn lower here in Europe, down 0.3% futures in the US. The S&P E-minis down 0.2%. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to You got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance, Early Edition. I'm Francine Lacqua here in Paris. Here's what's coming up on today's program. U.S. Treasury yields rise over growing credit risks, funding concerns, and heightened fears of default if Congress fails to raise the debt ceiling on time. Credit Suisse Chief Executive Ulrich Körner will join the UBS Group Executive Board as a Swiss lender announces a broad management overhaul following the takeover. Plus, China imports plunge as concerns grow about the nation's economy. Asian stocks rise after export growth tops estimates. So you've guessed us, we're here in the French capital, in Paris, for the Bloomberg Future of Finance Paris Forum. Now, business leaders and policymakers are here to explore the future of Paris as a financial center, and of course, the sustainability issues and tech innovations that are reshaping finance. We'll bring you interviews with chief executives, including the Chief Executive Officer of BNP Paribas, also Stéphane Bounja, Euronext Chief Executive. Now, investors, of course, will be a very close eye, of course, watching U.S. President Joe Biden and congressional leaders as they're set to discuss the debt ceiling later today. PIMCO co-founder Bill Gross recommends buying short-term treasury bills, as he says the issue will be eventually resolved.
I think it's ridiculous. It's always resolved, and not that it's 100% chance, but I think it gets resolved. I would suggest for those that are less concerned, similar to myself, that they buy a 1 month, 2 month treasury bill at a much higher rate than they get with a longer term treasury bill.
Now, for more on all of this, let's bring in Bloomberg's managing editor for credit, Dana El-Battaji. Dana, thank you for joining us. So how big of a deal for global markets is the U.S. debt ceiling debate? It's huge, but are they really starting to worry about it?
You're right. It's absolutely huge. But PIMCO is just the latest voice to basically come out and say how ridiculous the debate really is. At the end of the day, is the U.S. actually going to default? The chances of that happening are super slim. And as he points out, there's an unbelievable buying opportunity here. We're talking about yields that we haven't seen, in a very long time, sometimes ever. We're talking about an extra 250 basis points that you can easily make within the next 4 weeks. That is quite a significant buying opportunity here. So yeah, I understand that it's a big deal. I realize everyone is looking at it, but the odds of a default seem to be significantly low. Of course, those could be famous last words.
Yeah, I think we also spoke to Philip Hildebrand a couple of weeks ago from BlackRock, and he says, look, there's slim chances that something turns ugly, but if it's ugly, it could be Armageddon. What does the Fed's latest senior loan officer opinion survey show?
It seems to suggest that it is quite low. But again, I think ultimately what people are really looking at is U.S. CPI data, which is actually coming out tomorrow. If you take a look at the market today, it seems quite tame. That's mostly because at the end of the day, what people are most concerned with isn't necessarily this, it's mostly whether or not the U.S. is going to continue increasing rates, which is what we will probably see with the U.S. data tomorrow.
Dana, thank you so much. Bloomberg's managing editor for credit, Dana El-Battaji. So we'll have plenty more, of course, on the debt ceiling. Joining us is also Freya Beamish, Chief Economist and Head of Macro Research at TS Lombard. Freya, always good to speak to you, especially to cool off our hot-headed market moves. When you look at the debt ceiling, like what kind of positioning should we do right now? Should we prepare for it and hope for the best, or is it very unlikely that we will come to anything too ugly?
I mean, again, it can be famous last words, but we are working off of the assumption that something will happen probably at the last minute, which is kind of, we're approaching that period. So yeah, we're working off of that assumption. That said, over the summer, there are a few kind of headwinds and pitfalls for equities to get through. Of course, the debt ceiling being one of them. But I think more importantly is the sort of the point that we're reaching in the cycle, which is essentially that we're moving from the stage where inflation is driven by sort of all of the shocks that have fed through the system from COVID through to the energy to actually to the wage-driven part of the cycle, as is sort of right and proper for this stage of the cycle. But that's much more of a difficult thing for equities to stomach. And that's why we're sort of cautious on equities in the near term. But sort of looking beyond that, we do think markets have broadly speaking got it right in terms of the direction and the kind of the magnitude of the Fed funds rate. And it is a very forecast recession that we are still kind of holding out for. So we're looking for equities to sort of recover reasonably well, especially when you look at the central bank impulse, which has already turned in favor of asset prices, having been very much against asset prices through 22.
Yeah, overall, what kind of asset prices will we be left with post-recession? So are there longer-term legacy issues for inflation and higher returns?
Yeah, so I think markets are very much, I'm glad you asked that, because markets are very much getting things reasonably well right this year. But looking beyond that, that's where we have big concerns of over mispricing of asset prices. So this year we think that there will be a recession, but markets are sort of getting it wrong as to what the causes of that recession are. It's about breaking the speed limit. There's a recession because the rapidity of the increase in interest rates has just been so rapid, so strong that the economy can't stomach that. But the economy can stomach the level of rates right now over a longer term basis and can potentially stomach higher yields over a longer term basis. The same with inflation, that inflation could come down quite precipitously this year. And markets are kind of getting that right, especially if you include shelter and the lagged effects of previous price movements. But it's again about the causes of that. The causes of that decline in inflation are about COVID distortions coming out of the system. It's not about the secular trends in inflation, which we think are picking up. And there's a whole host of kind of factors that feed into that. But if you want a kind of a big picture idea as to where that comes from, you can think about the imbalances that we see in the economy right now compared with the imbalances that we saw contrasted with the imbalances that we saw in the wake of the global financial crisis. In the wake of the global financial crisis,
Freya,
it was
so we also had we also had some really disappointing news out of China. And I don't know if you put that into context of what you're explaining beautifully about a credit crunch, but also a lot of the loans may be disappearing in the US. Could we have a perfect storm emerge all at once?
I think we are looking at some more kind of global recessionary dynamics once you get through the kind of the reopening in China. So when we talk about the kind of the excess of debt in the global financial crisis, post-global financial crisis in the US, where that excess of debt is now is very much in China. So the US had an asset cycle over the 2010s. They built a whole bunch of what I would call hollow financial assets over the course of the 2010s. And that's much more of an inflationary problem that is causing central banks to have to squeeze out inflation. Where the problem is in China is on the debt side of the balance sheet, and that's much more of a demand deflationary story. So when you get the reopening story right now, yes, by all means, that means faster growth much more services-led fast growth, which is why it's not showing up in the imports in the first half of the year. But in the second half of the year, there's nothing to sustain that, and there's the whole legacy of that debt imbalance to work out on the balance sheet side of things. So there's the potential for the US to go into recession and China to slow quite precipitously towards the end of the year as well, and that puts you much more into kind of global recessionary dynamics.
And what are the spillover effects, actually, of this China slowdown to neighboring countries and the rest of the world?
So while the spillover effects of reopening are not particularly significant for the rest of the world, because it's all about services, and it's the first sort of cyclical pickup that's been led by the consumer sector as a result of this pent-up demand, the effects of the slowdown, the secular slowdown, are much more important. So the likes of the euro area, the likes of the export-dependent EMs are very much tied into that kind of deflationary force that's emanating from China, whereas the likes of the US and the UK are much more exposed to the more inflationary imbalances that are there in those economies when you look at that excess of financial wealth compared with the capacity of the economy to provide for the demand that excess of wealth generates. So we have these kind of deep-seated mismatches between demand and supply that have to be worked out in the likes of the US and the UK, and to an extent the euro area, but the euro area is much more exposed to the slowdown in China.
Freya, are you surprised? And I know this goes also into something that you mentioned with lending of, coming from banks in the US and the credit crunch that could potentially get worse. But it seems to have pretty much been contained, the fallout from, some of the stress that we've seen in the US banks. Again, famous last words, or do you think a lot of those worries are behind us?
So I think with regards to small and kind of medium-sized banks in the US, the mechanism by which that would turn into a more serious kind of systemic problem is deposit flight, and there is a destruction of deposits in the economy as a result of QT and the mismatch between interest rates being offered by banks and money market mutual funds. So that aggregate story is still there. But in terms of how that manifests and whether that actually tips off the key tipping point for small banks and regional banks, that would force them to sell down their held to maturity assets, and that particular mechanism has now been disabled by the Fed offering its new kind of term funding program, which means that instead of having to sell those assets and recognize the quite large losses that are embedded in the balance sheet, they can just go to this new facility at the Fed. So that sort of cauterized the systemic nature of this again, could be famous last words, but of this part of the crisis. But where we are kind of more worried is when you get to kind of illiquid and difficult to price assets more broadly in the economy, and that comes back to this idea of there being sort of hollow financial wealth that has essentially been created by the combination of large deficits through the 2010s and then again in the pandemic period, with the expansion of the central bank balance sheet, which is a perfect concoction to create this kind of financial wealth that doesn't really have a home in the real economy. In fact, it's created as a result of deficiency of demand in the real economy. So there's this big mismatch between financial wealth and the size of the real economy. And there's only a few ways that can kind of come back into balance, either through decline in prices in the financial world, or through increase in prices in the real economy. So it'll probably be a combination of both of those things, but that tells you that there's this sort of underlying inflationary, reflationary force in the real economy, but also this kind of propensity towards there being a denouement between the level of financial asset prices and the real economy, the likelihood there's going to be higher inflation, higher yields, deterioration of the geopolitical environment, the energy transition, and all these things bringing them back into line.
Thank you, Freya, which is why you say actually could emerge, the US certainly, and also the UK, out of this recession to higher yields. Freya Beamish there, as always, wonderful analysis, chief economist and head of macro research at TS Lombard. Now, coming up, we look at the banks. UBS has announced a reshuffle of its leadership after the emergency takeover of Credit Suisse. Who stays and who goes? We'll have all of the details next, and this is Bloomberg. you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back. So UBS actually appointing Todd Tuckner as Chief Financial Officer. Of course, he replaces Sarah Youngwood as part of the management overhaul following the takeover of Credit Suisse. Now, this is the share price for the moment, getting some 0.3%. Of course, when the deal closes, the bank says Credit Suisse Chief Executive Ulrich Körner will also become a member of the UBS Executive Board. Not something that many were actually expecting, although we had found out that there were possible conversations heading in those directions. So for more, let's get to Bloomberg's Manus Krani, who knows, of course, the story inside out. Manus, I don't know what that means. They're just trying to create a war machine, right? To be sure that they have all angles covered and then can move ahead in execution.
I think you're right. I think it's a surprise that Körner has stepped across. I mean, he's a veteran. He's had 10 years at both banks. He left in the reshuffle of 2019, Francine. Bear that in mind. He left during an Armati shuffle. I think what you have here is a very clear delivery for continuity, people who Armati has confidence in, and people who've been loyal to the UBS machine. And I've worked with Armati through turbulent times of turning UBS itself around. Let's just look at some of those changes, Francine. If you're a veteran and you know what you're doing within UBS, you've been rewarded, you remain on this board. I find it interesting that Rob Karofsky, who, he's only been there since 2014, I say only, but he will lead the investment bank solely. And then the Dauphin, as I call him, which is Iqbal Khan, I'm sure that won't go down well at home in Switzerland, but he remains sole president of the wealth management. So this is about continuity. But I think when it comes to Körner, of course, this is about the transition from what remains within Credit Suisse to come across for a phased period and a pivotal point in time. And there's some pretty significant female leads here as well, Francine. Just to give you some context, Michelle Béraud, she is head of transition and integration, 23-year veteran at UBS. So you could say herself and Armati are very closely aligned. Francine.
Manus, when you look at, of course, how, again, this is an integration that we're hoping legally, I think, will be done in the next couple of months. But then we also heard from the chairman of UBS that this will take maybe 3-4 years. It's extremely complex. Is it too soon to try and figure out, because, this happened 6 weeks ago, is it too soon to figure out how it's going so far?
I think it probably is. It's presumptive. And I mean, one thing which Armati was very clear about when we sat down, and listen to the tone in his voice. I'm glad you've met a few people that know how to run a Swiss bank, Manus. Maybe you'd like to introduce them to me. Facts, not emotion, will run the thinking of Armati. And if you look at the complexion of this, as you say, a war cabinet, almost a group of individuals, men and women, who will quite literally take this organization by the neck and reinvent who they are and what they are. To that extent, this is about creating a group of people who know one another very well, who know how to do the job. And I think where we are, Francine, with this right now, it's too soon to say what it is. 100 people have gone in there. We know the advanced posse, the advanced team are looking under the hood. I think when we get to the end of July on the next set of numbers, the market is going to want to know something really quite significant about what bad assets you're going to tank. And here's the thing, the structure will have 5 core parts: wealth, investment banking, personal and corporate banking, investment banking, and you got it. It's back at the top of the charts. Non-core bank, and that will be headed by Beatrice Gimerez, and she is a veteran of over 10 years. You're right, it's back in the top 5 on the billboard. The bad bank is back, and that is how quickly and aggressively that will be run down. The assets, as you and I have talked about several times, and the parts of the bank, Credit Suisse, that Ermotti et al. Do not want.
Yeah, and I know we both know Beatrice, a force to be reckoned with, I think, is how many people would describe her. Thank you so much, Manus Krania, there with the very latest on UBS. Coming up, we'll have plenty more on some of the big corporate stories we're following. Saudi Aramco says it's well-positioned to cope with fluctuating prices, and this is despite slightly disappointing first-quarter sales. We'll have the details next, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has 2 targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Finance, economics, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. We look today at the future of finance from Paris. But before we do any of that, and we also get to the earnings out of Aramco, let's check on the markets. And a bit of a wobble is probably how I would describe it. It's not a technical term, but it does feel that way, certainly when you look at the last 24 hours. So European stocks, U.S. equity futures edging lower. Investors, again, assessing the impact of slowing imports by China on its economic recovery. A lot of questions mark on what that looks like in the next 3 and 6 months. months. They also are preparing for a key U.S. inflation report. Now, real estate shares seem to be leading the declines in Europe, with Swedish landlord SBB falling to the lowest in nearly 5 years after the company announced plans to postpone a dividend, but also cancel a rights issue intended to shore up its finances. Onto another corporate, and Aramco says it will pay a performance-linked dividend, potentially boosting payouts for the Saudi Arabian government by billions of dollars. Now, this also comes as the world's largest energy company reports a miss on the first quarter operating profits. So to round up all of the numbers, let's get straight to Bloomberg's energy and commodities team leader. He's Paul Wallace. Paul, great to speak to you. So will this dividend announcement actually mean more money for shareholders, not least the Saudi government?
Hi, Francine. It certainly looks that way. We've already started to get some numbers coming through and forecasts coming through from analysts, and we've got Bloomberg Economics saying that this could boost the dividend, which already stands at about $76 billion, by $20 billion or more. RBC Capital Markets is predicting $12 billion to $18 billion of additional payouts from the company. So this is looking like a pretty good move, a pretty big move from Aramco, and we've already seen a stock surge this morning. The shares were initially up by about 7%. They've sort of trimmed gains a bit, but that just sort of shows you that investors are pretty excited by this.
So, Paul, what does the government, does the government actually need more money from Aramco?
Well, it will certainly, if oil prices stay where they are for the rest of the year and Aramco follows through on this plan for sort of performance-linked dividends, then it will mean a lot more money for the government, which directly owns 90% of the company. And with oil prices dipping, yeah, it could do with the additional money.
Yeah. Paul, thanks so much. Paul Wallace in Dubai. Now, coming up, we'll have, of course, a deep dive into finance. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking to do.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this, and what the Fed does potentially?
This is so exhausting, and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
U.S. Treasury yields rise over growing credit risks, funding concerns, and heightened fears of default if Congress fails to raise the debt ceiling on time. Credit Suisse Chief Executive Ulrich Körner will join the UBS Group Executive Board as the Swiss lender announces a broad management overhaul following the takeover. Plus, China imports plunge as concerns grow about the nation's economy. Asian stocks rise after export growth tops estimates. So good morning, everyone. Happy Tuesday. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Paris. Now, also joining us in Paris a little bit later on is, of course, JP Morgan with their Capital Markets Forum. Business leaders have offered a gloomy assessment of London's place in the league table of global financial centers. Now, Jan du Plessis, chair of the Financial Reporting Council, even blames this on a series of factors, including over lower CEO pay and a reluctance to embrace change. Meanwhile, the Revolut co-founders actually told the Times newspaper they would not consider listing in London. Now, ahead of their Capital Markets Forum in Paris, let's discuss all of this, the attractiveness, of course, of London, what's in the pipeline with one of the most powerful bankers in London. This is Viswas Raghavan, JP Morgan's EMEA chief executive, live, of course, from their chief executive officer event in London. Viz, always great to speak to you because you always make me smarter on the ins and outs of a lot of these financial centers. How do you see London growing or not growing as a financial center in the next 5 to 10 years?
Morning, Francine. So look, I think I would put the factors surrounding London into two buckets. You know, the controllable and the uncontrollable. If I look at the uncontrollable bucket, I mean, clearly there are geopolitical shifts which are not favoring listings. I mean, not just in London, but across Europe. Remember, historically, London has been a big magnet for emerging market listings for developing economies. So Russian companies used to list their GDRs and do some main listings. Companies from India, emerging markets, etc. You know, a lot of that is kind of disappeared. China is more domestically focused, A-share and H-share listings. And clearly there is Brexit. So clearly Brexit has kind of cannibalized the listing pool. A lot of European companies are now listing on European exchanges. So there are a bucket of factors which I'd put in that kind of uncontrollable bucket. But within the kind of increasing the attractiveness kind of quotient in the controllable bucket, clearly London has historically, you know, been a great money center. The rule of law, quality of regulation, I think that's a huge plus. The FCA's reforms, proposed reforms around regulation, the Edinburgh reforms. I think what is being considered is kind of making sure that we don't gold-plate it and keep the attractiveness kind of alive. And then clearly the pool of talent, the international multicultural talent, that needs to continue. And also, most importantly, you know, if London continues to be a magnet for entrepreneurs who create jobs, who create wealth for themselves, for their employees, if that kind of magnetism and the attractiveness of London continues, then clearly I think the outlook could be positive. But it's very important that those controllable factors we are on top of those.
Yeah, and at the same time, there's been a lot of pushback, for example, because of the CMA's, you know, decision on Activision Microsoft. So are you worried that we're going to have a less favorable regulation that will take business away from London? And what does that mean for JP Morgan?
I mean, look, I wouldn't read too much into the CMA's decision on Microsoft. I think you have to evaluate these on a case-by-case basis. So, you know, the UK happened to be first. It could have been the EU Markets Authority, or it could have been the US kind of regulators. So you cannot infer too much or extrapolate from just kind of the Microsoft decision. And really, there are a lot of other factors that go into it. I think that the key is really all the factors that made London kind of a magnet and a hub for global capital, that global money center, the advantage of the time zone, that attraction of, you know, top talent. We got to keep doing all of that while making sure that it is a very kind of a proactive and an environment that fosters entrepreneurship and really kind of look to the green economy, technology, life sciences, really as a magnet, because also what we cannot underestimate is when you look at valuations, especially from a U.S. perspective, there is a valuation uplift to be had from, compared from a London domicile to kind of, redomiciling to the U.S. And some companies have trod that route. So I think that is something which, companies really are considering and evaluating all of the time.
But Viz, so for you, for example, since Brexit, you have to duplicate costs because you have to have a hub also in Europe, and how sustainable is that?
I think there is an element of duplication, but from a listing point of view, remember, as a board, as a CEO, as a management team, and for the shareholders, the key is to access as many pools of liquidity as possible, so that your stock, your equity story, your investment thesis is getting the widest audience. You're getting an active following, so and really kind of benefiting in terms of valuation. So the key drivers there are really having as broad a following for your investment thesis, for your equity story, and getting the kind of the valuation uplift. In terms of whether it is two exchanges, if there is an increase in cost, whether there is duplication, I think it is really around the fringes. I think the key here is having a broad following, and that you are really kind of trading at the multiple that you deserve, and that your stock and your story justifies.
In terms of business, Viz, when are you expecting the pipeline to pick up, deal making to pick up, and if not returning to maybe more normal levels, certainly better trends that we're seeing now?
You know what? I think I am really half full on that. If you look at investment banking, kind of the fee pool, before COVID, the global fee pool was around 80 billion or thereabouts per year. And through 2021, 2021, that fee pool, absolutely catapulted to around $135 billion. And that was really fueled by a lot of liquidity in the market. There was kind of a lot of, central bank money and a lot of kind of COVID-related stimulus. And what you saw through 2022 was that fee pool shrink. So we're back at around kind of the mid, 75 billion or thereabouts. And when you look at the pipeline, we've seen a bout of successful IPOs, both sides of the Atlantic. The debt markets are selectively opening up. And the M&A market, really, I think it has got, it's showing signs of life. So it is not going to go back to the kind of the glorious 2021 type volumes, but it is not as bleak either. There is value, and there is also a kind of a meeting of minds between buyer and seller, and there is a kind of a valuation kind of matching that is slowly taking shape. So the glass seems more half full than half empty, and for the right names, for the right stories, the capital markets are wide open.
Viz, are private markets a way in for banks, or are they too dangerous just because of the lack of liquidity and where we are in the cycle and the possible credit crunch coming?
I mean, look, I think when you talk about banks, what we saw around kind of SVB and Signature and First Republic, it's a bit idiosyncratic. It was kind of, those were unique situations. There was kind of an asset liability kind of mismatch situations. If you take broad banking, there are generally, whether it is the United States or in Europe, the large banks are all prudently capitalized. They're in good shape. And so I would say, generally, credit conditions are tightening. There is selectivity. Liquidity generally in the market is a lot more selective. There is a flight to quality, but that is to be expected given where we are in the economic cycle. That is kind of, quite natural. But overall, I would say, if you look at the broad kind of market, you are seeing a general kind of tightening, and investors, boardrooms are naturally cautious given the economic prognosis.
If it's just one final question on the rollout of Chase, how's that going elsewhere? So outside the UK, are you still planning the Germany launch, and what happens after Germany?
So look, I mean, Chase in the UK is really going extremely well. We have way over 1 million customers, and we're doing really well on deposits. And as you know, we've been hiring in Berlin. I cannot comment on what the next kind of phase of expansion looks like, but the reasoning behind hiring folks in Berlin is really kind of to make that kind of the center for whatever our European plans end up being. But overall, a fantastic start, and really it has been a kind of a great story in terms of the number of jobs we've created in the UK. We've hired more than 1,000 people now, so it's been a fantastic start to Chase.
Viz, thank you so much. Viswas Raghavan, EMEA Chief Executive Officer at JP Morgan, joining us for an exclusive conversation on banking and Paris and the UK and, of course, Berlin. Coming up, we touch on this week's MLive Pulse survey, asking which developed economy will suffer the most in 2023. Spoiler alert, it's not looking great for the Brits. That's next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line of success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
There's enough real growth for everything to work.
Our expectation for actually GDP growth is just above 1% for this year, but pretty much a flat 2024. And that is concerning.
The UK is showing tremendous resilience. It's a very stable position for us in the UK bank at the moment.
In Australia, we're taking a bit longer to get back to the inflation target than is the case in some other countries.
What we see in Europe, we basically qualify it economically as look-through, yeah? So we don't see a recession coming. We basically see some growth, even if it can be a bit sluggish.
Well, this week's MLive Pulse survey focused on the world's biggest economies ahead of the G7 finance ministers meeting this week. Now, the other thing, of course, we're focusing on is what happens to living standards in the UK. Now, to go through all of the results is our Bloomberg senior reporter, John Stepek. John, good morning. You're great at putting all these things together and making us look good or not. But actually, for the Brits, it's just not looking great, full stop. Or is it?
There's a bit of a spoiler alert there, Fran. But so we asked this question of our readers. Which country do you think is going to see the biggest drop in living standards, as in the biggest fall in real wages? And by far, the most votes went to the UK. Roughly 60% said it's the UK, with Italy being a distant second. Now, I mean, it's interesting because obviously the UK is actually doing an awful lot better than anyone expected 9 months ago. Back then, everyone was saying we'd be in a recession. Bank of England was saying it'd be the longest recession, essentially in living memory. And as it turns out, we're not in recession, and growth is not great, but it's not awful. However, it's very clear that the cost of living crisis is still front of mind. And I think we probably saw that reflected in the local election results last week.
So what does this mean for investment implications, John? How do readers feel about investing in the UK?
Well, again, the interesting thing there is, so we locked the readers in a room and said, you have to invest in a UK asset. So the FTSE 100, FTSE 250, gilts, or UK houses. Anyone who wants to buy a house right now will probably be pleased to hear that no one wanted to invest in UK residential property. But the most popular investment was the FTSE 100. Now, what's interesting about that, of course, is that the FTSE 100 is not really a UK investment. It's certainly not an investment in the UK economy. It's an investment in global companies that happen to be listed in the UK. And so it reflects the same grumpy sentiment that we saw in the first question.
John, thank you so much, as always, for all of the analysis. Bloomberg senior reporter and Money Distilled newsletter author. It's a really good newsletter, so I urge everyone to go and actually sign up to it. John Stepek joining us this morning on the MLive survey. Now let's get straight to the Bloomberg Business Flash with Sarah Halls. Hi, Sarah.
Thank you, Fran. Aramco will introduce an additional dividend, potentially boosting payouts for Saudi Arabia's government by billions of dollars. It comes at a time when weaker oil prices are pushing the kingdom's budget into a deficit. Aramco says the new dividend will be between 50% and 70% of the company's annual free cash flow. China's export growth slowed last month, while imports plummeted, adding to pressures on its economic recovery. According to official data, imports dropped almost 8% in the year to April, much worse than the median projection of a 0.2% decline. Exports grew 8.5% over the same period, partly due to a favorable comparison with last year, when much of the country was under lockdown. PayPal shares fell in extended trading after the company lowered its adjusted operating margin forecast. The payments giant says it now expects the margin to grow by about 100 basis points this year, lower than its earlier forecast of 125 basis points. The weak guidance overshadowed PayPal's first quarter earnings beat and its higher full-year profit forecast. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Fran.
Thank you so much, Sarah. Now, Goldman Sachs is to pay $250 million to settle a gender pay case. That's after it struck a deal with 2,800 women who filed a class action lawsuit claiming they were systematically underpaid. Now, the trial would actually have provided rare testimonies about inequality in the finance industry. So to dig a little deeper into some of these inequalities and how far or how not far we've come is Ruth David, our London bureau chief, who joins us now. So Ruth, good morning. Tell us a little bit more about the case.
Morning, Fran. So, as you said, this is been one of Wall Street's most public and most long-running cases when it comes to gender and pay discrimination. If you recall, Christina Chen Oster, who was the key plaintiff here, she first filed a complaint in 2005. and she could go to court only in 2010, and it took her another 8 years to get more, about 1,400 more associates and VPs added on to that complaint, and that number has now grown to 2,800. This is a pretty large chunk of women that are saying we have been discriminated against in the workplace, and we have been given less pay. There was also a claim to talk about how it's a boys' club, which was rejected because the judges said that that's not going to come into a class action lawsuit. But the fact that Goldman has settled, if you think about what the bank is trying to do, is not very surprising.
So, Ruth, I was going to ask, what will Goldman do next?
Well, so the money, if you 215 million looks like a lot, but put it in context. Our excellent reporter, Sridhar Natarajan, who was talking about Goldman Sachs and who broke this story as well, was saying that in November 2022, there was a partner who had sued Goldman and they did a confidential settlement for 12 million. I think the bigger thing to keep in mind is they're saying they'll get an independent expert in, they'll look at their promotions process, they'll look at pay for the next 3 years, and that in terms of institutionally changing these organizations. Keep in mind that 6 of the biggest US banks, only one of them has had a female CEO ever. That seems to be more of a win effect than just the money that we're talking about here.
Ruth, thank you so much. Our London Bureau Chief there, Ruth David. Now, coming up, we'll have plenty more on geopolitics. Putin fans the flames of nationalism and looks to rally more support behind the war in Ukraine at his Victory Day remarks in Moscow's Red Square. So we'll discuss more on that next, and this is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer, Wednesday on Bloomberg.
Vladimir Putin said the world is at a turning point, speaking at today's Victory Day parade in Red Square in Moscow. Now, the Russian president used the occasion to mobilize support for the war in Ukraine, claiming the conflict had been unleashed on Moscow. Now, this year's festivities have been overshadowed by security concerns in other areas of the country. So for expert analysis, let's bring in Bloomberg's EMEA news director, Roz Matheson. Roz, you always make us smarter on these very complex issues that has to do with geopolitics and foreign policy. How has the big parade differed from previous years?
Well, mainly it differed in size. What we saw was a lot of troops marching up and down, but we only saw one tank, an antique tank, which usually appears at these parades anyway, but no other armoured cars, no series of tanks, no flybys by warplanes, and certainly no big missiles on display. And the reality is all that kit is being used at the moment for Putin's war in Ukraine, so you had less of it to put on display in Moscow today. And of course, there were other parades that were cancelled in other parts of Russia, really to kind of collate what he had to put on display in the Red Square this morning. So what we saw is a really slimmed down display in terms of the machinery that was there. Certainly we saw the usual troops marching by and so on, a lot of patriotic comments from the Russian president in his short address at the start. But if anything, what it highlights is the toll that this war has taken on Russia's military establishment.
So what are your main key takeaways, Ross, from Putin's comments? I mean, he says it's not Russia's fault, and that's basically to rally support from his people.
Well, that's right, and that's the narrative he's been adopting for a while now, which is that Russia is fundamentally under attack from the West, and therefore this war is about that. It's really a change in narrative from the early days of the conflict, when he was talking about reclaiming territory that he said was fundamentally Russian. So now he's casting it very much for a domestic audience, that Russia is under siege from the West. This is about NATO, this is about the US, this is about all these countries who are really seeking to contain Russia and push it back. And that's really, really aimed at the domestic audience inside Russia. Of course, you know, more than a year into his war, he's still on the back foot on the ground in Ukraine, no great signs of tangible progress there. So he really needs to rally the Russian people by saying, you know, you have to join forces with me here because it's us against the rest of the world. And that really is a repeat of the narrative we've seen of late from him.
Roz, thanks so much, as always, for your expert analysis, Roz Matheson. Coming up, we'll have plenty more from Paris at the Future of Finance.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make
Clearly, the risk is that inflation is going to prove a lot more sticky than people are currently expecting.
I don't think there's much of a chance to get back to 2% absent a severe deflation. It's a 3 to 4% environment going forward for me.
I'm not sure that rate hikes actually causes inflation to go down. I think the Fed should, and central banks in general, should be using more tools, not just the rate hike tool.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. U.S. banks reported tighter standards and weaker demands for loans in the first quarter. That was before some of the recent stress in the banking sector emerged. UBS is overhauling its top management team following the takeover of Credit Suisse. The CFO is being replaced, and Credit Suisse CEO Ulrich Körner will join the UBS executive board. And a crucial meeting at the White House today over the debt limit stalemate. Senator Republican leader Mitch McConnell says he's not coming to President Biden's rescue with some secret plan. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Kriti, it is very good to see you on the programme. And of course, we have a big focus on the US debt limit this week and the extent to which any political solution can be found there as we work our way towards the data point, which has got to be US inflation tomorrow.
It absolutely is, Anna. A pleasure to be with you always. It's all about Washington. The idea here that's not just about the inflation numbers that we are going to get, but also to your point, that debt ceiling story. Interesting, all eyes on Washington right now. But if you look at what the market's doing, Anna, the answer is not a ton. Take a look at futures right now, only down 0.3%, not seeing real momentum, real conviction. And even as the market does sell off, you see a lot more action on the micro front than the macro. Even the 2-year yield kind of shrugging his shoulders a little bit because, look, Anna, this can go in any direction when it comes to just how Washington approaches this debt ceiling, or if we are going to really go to the 11th hour. There, 2-year yield hovering around 3.98, kind of a pullback from that 4% level. But remember, that technical level is key when we talk about the trade. What's interesting is even as yields come down across the curve, you are seeing the dollar just marginally higher, a tune of 0.1%, really a function of probably what's going on abroad. NYMEX crude trading at a 72 handle. Anna, this is the asset that I really have my eye on, because if you are worried about inflation really quickly turning into a recession, commodities are really where that's going to show. It's going to be the very first pain point. And right now, we're still at a 72 handle. We haven't quite started ringing those alarm bells. How much of that is a question of demand and supply as opposed to really trading in line with risk sentiment?
Right, let's have a look with that in mind. And I've pulled out the oil price as well, Kriti, so that's a feature of the European story today. Let's have a look at what's going on the equity markets, though. Negativity, fairly gloomy red picture across these European equity markets this morning. Down by 0.6% catches my eye over in the Paris market. And broadly speaking, across Europe, we are pretty risk on. Most sectors in negative territory. And in fact, sentiment seems to have deteriorated as we've gone through the first couple of hours of the European trading day. Let me pull out one stock for you that really represents some of the tensions we're seeing in the real estate sector. And as rates have gone higher in Europe, the Swedish property market has been held up as an early example of what can happen in terms of the tensions in the property market. And I will not at all attempt to say the full name in Swedish of this business. I do apologise to Swedish viewers, but I can't just go there. SBB is what it's often known as. And this is a business that operates in the commercial real estate sector. And they've had to pause their dividend. This on the back of a downgrade to their debt yesterday. That came from the ratings agency S&P. So as a result of that, a lot of eyes on SBB. Will this be something of a canary in the coal mine for the tensions that we see in the Swedish property sector and elsewhere? How much could that spread? Now, this is Pearson. This is a publishing business. It's been really under pressure of late. We've seen a couple of days where this stock has really come under pressure as a result of what rivals have been saying or the market suspects will happen in the face of artificial intelligence and generative AI in particular. Now, the company has confirmed its guidance today and said it is working to work a generative AI into its business model. So as a result, Pearson goes higher by 2.6%. We had an interview with Martin Kazaks over at the ECB, and that's really interesting when you think about how long the ECB will keep hiking rates for, even if the Fed is on pause, and we'll see if that comes to pass. But the euro is down 0.2%, despite the fact that Martin Kazaks says that the ECB can keep hiking, even if not just that the Fed pauses, but even if the Fed cuts. That's his view. And this is Brent crude, Chrissy. You were mentioning WTI. It is down by 0.8%. Brent crude 76. We started last week at around $80 a barrel. We got nervous about the global growth story, and we dropped down to around $73 a barrel, it seems. Then for the last couple of days, we have seen some movement to the upside as a result of concerns around wildfires in Canada and what that does to supply. But right now, it's been a very volatile picture.
Certainly a lot to keep an eye on, both on the macro and the micro front. But let's get back to the macro here. The Federal Reserve saying U.S. banks reported tighter standards and weaker demand for loans in the first quarter. Bloomberg's Danny Berger joins us now with the detail on this Fed survey. Look, Danny, we never pay attention to the SPLOOS report, and yet here we are, all eyes on them yesterday. What did we find out?
Pretty, come on, you gotta pay attention to the SLUs always. Look, part of what we saw was this big debate unfurling. Just how bad was it? One camp saying, look, it was already really tight before SVB, or it was getting tighter, so what's a bit of incremental tightness? But we did see a net 46% of banks have further tightening. So that's an additional amount of what we saw after last quarter. So it does just show that conditions remain tight, and the longer they do so, the more borrowers will be hit. Cameron Price also has a really good read on this too, that it's not necessarily just about these tighter conditions, it's about the demand picture. That has just completely evaporated. It is a dynamic that's more commiserate with a recession. So again, that supply and demand dynamic really is what we should be focusing on here.
Yeah, really interesting, isn't it? Because on the demand side, some voices, Goldman Sachs, I think, were calling for that number on the supply side, to jump to 60% or so. We didn't see that, but we did see, as you say, this drop-off in demand for credit. Now, what about other measures of credit tension in the U.S. economy? We've heard from the Fed, haven't we? A financial stability report.
Yeah, financial stability report. I did think you were going to go to Goolsbee yesterday, who said he was getting vibes of tighter credit. He did say the word vibes. That's not me editorializing.
Not sure how we measure that.
Yeah, I'm not sure, and you'd hope the Fed would measure more than just vibes. But yes, there was the financial stability report. Maybe this is kind of vibes too, because they say, look, given the economic outlook, given concerns about credit deterioration, concerns about funding liquidity, that perhaps we will see a contraction in the supply of credit to the economy. Now, to be clear, this is not a forecast. They're simply just laying out their biggest risks. So they're not saying, okay, this definitely will happen. They also highlighted a few other things, some structural vulnerabilities in short-term markets, be that stable coins, be that money market funds. Also some concerns when it comes to office real estate, saying that it stepped up the monitoring of CRE loan performance and banks with some of that commercial real estate exposure.
Okay, Danny, thanks very much. It's Danny Berger with the latest on the credit focus that we keep stateside, of course, and that's certainly part of the conversation this morning. Let's get to other measures of tension within credit markets. And SBB, one of Sweden's biggest commercial landlords, plans to halt payments of its dividend after suffering a ratings cut. Now, the ratings cut came yesterday in session, but the new information overnight was the cut in the dividend. Joining us now is Anton Weiland in Stockholm, who can give us details of what happened here and why, because this is a story that's getting quite a lot of international attention, Anton.
Yes, so shares are down today and was already down a lot yesterday after its credit rating, this company which holds a lot of public properties and residential homes too, it was downgraded to junk by S&P. And this really puts focus on the issues for Swedish real estate firms, which holds a lot of bond debt maturing this year. They have some $41 billion of bond debt maturing within 5 years, and a quarter of that is due this year.
So Anton, for the reasons you just stated, kind of seen as a bellwether or some sort of canary in the coal mine for not just Swedish real estate, but the European property sector broadly. But put this into some context for us. When it comes to Swedish real estate specifically, just how bad is it? Is this an isolated incident?
Well, the thing with Swedish property firms is that they have taken on a lot of debt to grow quickly in the past years when rates were low. The problem is that debt is short and with floating interest rates, so they're particularly sensitive to rising rates. And what happens now is that bond market is too expensive to finance on, and they will seek bank funding, but banks in Sweden are already exposed to this industry. So other options are halting dividends, as we saw last night, also selling assets. One issue with this is what will happen to property valuations if we see fire sales. So alternatives are quite few for Swedish property firms at the moment.
Anton, thank you very much. Anton Weiland in Stockholm for us on that developing story around SBB, and it sort of taps into broader concerns globally around commercial real estate, other parts of the real estate sector in focus as well, as rates have been rising so quickly, of course. Now, sticking with financial services news, UBS is overhauling its top management team following the takeover of Credit Suisse. Marion Halftermeyer joins us, Bloomberg finance reporter in Zurich, with the details. Tell us what stands out to you in terms of the management changes. I suppose the CEO of Credit Suisse staying on is quite a big deal.
It is a big deal. What stands out most to me is that Sergio Matti, the new UBS CEO, is really sticking to personnel that he knows well from his time running the bank 2 years ago. So we see a lot of executive changes this morning, and they are all UBS personnel from internal. And then Uli Kerner, if you'll remember, the Credit Suisse CEO, was actually a former executive of UBS as well. So he's really sticking to people who he knows he doesn't have to get up to speed with, who he can trust, and who can probably jump very quickly into making this integration work.
Well, talk to us a little bit about this Credit Suisse side as well, because not only is there a shakeup on the UBS side, but Zoltan Pozsar, a heavily followed strategist, exiting the firm. What do we know about that?
So we've seen a lot of high-profile people leave Credit Suisse before the merger and in the wake of the merger. He is yet another high-profile name. We had Michael Strobeck, one of the lead strategists for the Chief Investment Offices of Credit Suisse, also leave recently. So that's not great. That means UBS isn't able to retain some of these key, really high-profile people that would have made this merger and this franchise even better.
Marion, thank you very much. Bloomberg's Marion Halftermeyer in Zurich. I'm very pleased we got to fix the microphone there as well, but we got the gist of what Marion was telling us. Really interesting story to watch as that develops, as the integration comes into force. Now, coming up on the program, Aramco introduces an additional dividend. We will dive into the oil giant's first quarter results next, what that means for the business, for oil markets, and for the Saudi state. And Ruqaiya Ibrahim joins us, Daily Insight strategist at BCA Research. So much to talk about around the debt ceiling, around the Fed narrative. When does she expect the Fed to move, and in which direction on rates? We'll get to that shortly. Plus, Washington tries to break the debt ceiling impasse today. We will speak with Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store. so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Vladimir Putin vowed to pursue his invasion of Ukraine, accusing the Kremlin's enemies of seeking to dismember Russia. Putin spoke at the start of the annual military parade celebrating the Soviet victory in World War II. He said that a real war has been unleashed against the motherland. Goldman Sachs will pay $215 million to settle a long-running class action lawsuit on underpaying women. The case involved about 2,800 female associates and vice presidents. It was closely watched in an industry where women have long said that complaining of unfair treatment can derail careers. In China, more pressure on an economic recovery that's already been called into question. Export growth slowed last month to 8.5%, which beat expectations. Meanwhile, imports plummeted almost 8%. Economists warn that the strong export figures aren't likely to last forever. Shipments are expected to drop this year. And in the UK, mortgage rates have started to head higher again, reversing a downward trend. The big six mortgage lenders increased rates slightly on the average 2-year fixed-rate mortgage last week. It now stands at 4.65%. The cost of a mortgage is likely to climb higher if the Bank of England keeps raising rates to fight inflation. Now, Anna, that seems to be the core of the issue around the world when it comes to the property sector, but extra tough for citizens of the UK who are already dealing with a cost of living crisis.
Right, I mean, and what we saw here, of course, was that these rates jumped around the time of that October so-called mini-budget, and then they dropped back down again. They sort of normalised after that, and we had a change of management, as we know, here in the UK. But then that still meets a rising tide of interest rates globally, and not least from the Bank of England. So rates still generally seem to be ticking higher, or at least have returned to doing so. Coming up on the programme, we'll get back to that Aramco story as it introduces that additional dividend. We'll dive into what that means for the Saudi government, for the oil giants' business, and much beyond. This is Bloomberg.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now, the PIMCO co-founder Bill Gross says rather than buying or selling banks, investors are better off selling volatility of regional lenders. Gross spoke on Bloomberg yesterday.
You know, we've got a situation where there's value, but we've also got a situation where investors are still leery based upon deposits and the lack of deposits.
And so talk to us why then we're talking about an ETF. Obviously, if you look at the regional bank landscape as a whole, there's been some specific names that have really seen the brunt of the action. PacWest in particular over the past week has been extremely volatile. So if you're looking at this situation evolving, does it make more sense to go into something like KRE that tracks all of these names versus trying to pick one?
Well, I think for the conservative investor, it does. The diversification is a positive, and KRE is not as volatile as some of the ones that you mentioned. That's not what I've done. As a matter of fact, I think buying the stocks or shorting the stocks is really not the way to go from here. I think what you want to do is sell the volatility in this particular sector. The volatility on many of these stocks is extraordinary. On PacWest, it's 300 normalized, which I know is technical, but is extremely high volatility, and it's the same thing on many other stocks. I've been selling volatility on Western Alliance, it's WLAL, and on Zion. Both of those volatilities are much higher than normal, higher than 100, and you know, should the market simply stabilize, which is what I'm talking about, what I'm thinking at these lower levels, then a 2-week or a month and a half option, what I call a strangle, you know, selling a put, selling a call at 10% above and 10% below, you know, they provide a very, very potentially profitable investment as opposed to simply buying the stock or selling the stock.
Well, PIMCO co-founder Bill Gross there with some pretty interesting recommendations, not necessarily buying and selling the shares, but selling the volatility of the banks instead. And speaking of volatility, shares of Aramco jumped after the company said it would introduce an additional dividend, potentially boosting payouts for Saudi Arabia's government by billions of dollars. Bloomberg Saudi Arabia Bureau Chief Matthew Martin joins us now from Riyadh. Matthew, talk to us about the story. Why is Aramco changing its dividend payout when a good chunk of Wall Street and global Wall Street is saying oil prices are only going to go down from here?
Yeah, well, Aramco has been coming under pressure for quite some time to return more cash to shareholders. The investors who take up the small 2% stake or so, which is freely traded, feel like they're not rewarded enough. The dividend yield has only been around the 4% region for a long time, so that's not rewarding enough for those shareholders. And also the Saudi government as well is embarking on this massive diversification projects at the moment, and so it needs more cash as well. So I think both those forces have come together to encourage the company to do more in terms of returning more cash to shareholders, and we've seen it over the past year. Obviously, oil prices very high last year. It generated a huge amount of cash, and so now it's looking at being able to return more of that to those shareholders and increase liquidity in the stock.
Okay, and where does the money go? Who stands to benefit? This is about the Saudi government as well, isn't it?
Yeah, absolutely. The government still owns 90% of the shares. It's forecast to have a small deficit this year in the government budget, so increasing the dividend is probably going to help cover up that deficit this year. There's also around 8% of the stock is now owned as well by the Sovereign Wealth Fund, and the Sovereign Wealth Fund, the PIF, has obviously been investing a huge amount of money domestically and internationally, and so having that income stream from this Aramco stake and these higher dividends now is going to help it fund all of that. So this is going to be a very good news day for the Saudi government and for the Sovereign Wealth Fund as they look at collect these bumper takings from Aramco.
Matthew, put this into perspective for our global audience here. You talked about just how good this is for the Saudi government. Why do they need this? Talk to us a little bit about the Saudi budget here.
Yeah, so last year the government had the first surplus in almost a decade. This year the government was forecasting another surplus. However, a lot of analysts have become a lot more skeptical about that and said that Saudi Arabia probably needs oil prices in the region of $80 a barrel or perhaps higher to be able to balance the books. The spending plans that have been announced on these various projects like NEOM, like the other tourism projects and other economic diversification projects probably run into the trillions of dollars. So clearly the government needs to be able to find cash where it can to be able to fund these things, because so far the foreign investment into those projects has not been coming. So I think this move that we've seen from Aramco in shifting the dividend calculation is all part of helping make sure that there's more money flowing from oil revenues into these entities which are funding economic diversification projects, which is really key for Crown Prince Mohammed bin Salman as he tries to embark on this reform drive that he started.
Okay, Matthew, thank you very much. A long-running story then in terms of that diversification. Matthew Martin joining us from Riyadh. Coming up on the programme, we'll get back to today's markets. Ruqayya Ibrahim joins us, BCA Research Daily Insight strategist. How concerned is she about the drop that we saw in demand for credit in the US economy, on top of a tick-up in sort of tight credit conditions from those who provide it? We'll talk about credit in the US markets, how that feeds into perhaps the Fed conversation as well. What does that mean for how soon or late we see cuts in rates from the Fed? This is Bloomberg.
on countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. U.S. banks reported tighter standards and weaker demands for loans in the first quarter. That was before some of the recent stress in the banking sector emerged. UBS is overhauling its top management team following the takeover of Credit Suisse. The CFO's being replaced, and Credit Suisse CEO Ulrich Körner will join the UBS executive board. And a crucial meeting at the White House today over the debt limit stalemate. Senate Republican leader Mitch McConnell says he's not coming to President Biden's rescue with some sort of secret plan. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest stateside, but of course the European session is going to certainly influence how the trade pans out here. Walk us through what we're seeing.
Yeah, absolutely. We've got some weakness coming through on European equity markets as we've seen a little bit of that weakening in US futures. We've gone down in sympathy perhaps here, but down by 0.6%. We've seen a more resilient start to the trading day. The London market was closed yesterday, had to play a little bit of catch up, tried to stay positive, but has succumbed to the downside. And most sectors now in negative territory. So we find ourselves down around 0.6% on the Stocks Europe 600. Here's the Swedish commercial real estate business, actually a large player in the commercial real estate business, SBB as it is colloquially known, and thankfully for those who cannot say that in Swedish. But the stock itself, really interesting, is down by 11% today, and it's been seen as quite a canary in the coal mine for, well, the Swedish commercial real estate sector, but also the broader real estate sector in Europe as well. This is because it has quite a lot of floating rate notes that it needs to refinance in 2023, and of course, as rates have been rising globally, that becomes more expensive, in particular for this business, because it was downgraded yesterday to junk. Overnight, they then said that they were cutting back on the dividend, or delaying the dividend rather, so as a result, the stock drops quite substantially. Here's the euro, down 0.2% at 109.83, kind of stalled around that 110 mark, haven't we, since we got that ECB rate decision. We had heard from Martins Kazaks at the ECB, and he's been saying that the central bank can continue to hike rates, even if we see not just a pause at the Fed, but a Fed that is cutting interest rates, which is an interesting thought. Whether we see that timing mismatch would be a really interesting market development, but for the moment, the currency not responding too much to that kind of thought process. Brent crude is at 76.39. We started last week, of course, Kriti, with a Brent crude price around 80, dropped down to as low as 73, now back up at 76. A lot of volatility in oil prices.
Yeah, it's certainly something you are seeing stateside as well. And we'll start from bottom up here. For our radio audience, stick with me. We're looking at NYMEX crude. Anna just mentioned 76 on Brent. NYMEX at trading at a 72 handle. So still seeing about that $4 premium there. Still down by 0.8% stateside. And that really, again, speaks to the idea of the recessionary story. If you are worried about a recession in the States, it is going to show up in the NYMEX pricing. Certainly something to keep an eye on. But look, they're also factoring in the dollar, and that's really where you see it kind of unchanged today, despite the fact that yields are ticking lower. On the front end of the curve, two-year yield really testing that 4% level. We're at 3.98 there. Two-year yield coming back down. It's interesting, though, that you are seeing this bid for the bond market, even as the equity market sells off. And I think a lot of that comes, Anna, from the flow that you just mentioned in Europe specifically. Sentiment around the world souring today, whether it's the banks, whether it's the debt ceiling, whether it's the Swedish story in Europe. It kind of feels like the vibe, for lack of a better term, or to quote Austin Goolsbee of the Chicago Fed, is sell and pursue a little bit of safety.
We can certainly deal with vibes, can't we? Christy, let's move on to our next conversation. Ruqaiya Ibrahim joins us, BCA Research Daily Insights strategist. Ruqaiya, very nice to have you with us. So the vibe does seem to be fairly negative, certainly sitting here in Europe, down 0.6% on the Stoxx 600, Ruqaiya. Is this the debt ceiling narrative weighing on sentiment? And is it right that the debt ceiling weighs here? To some extent, we've seen stocks shake off concerns around the debt ceiling, whereas we've seen the short end of the Treasury curve actually pricing in some volatility, or at least being moved by this story. How do you see this playing out for markets?
Yeah, I do think that that's reasonable to expect some volatility on the back of the debt ceiling. I mean, unlike the 2011 and 2013 episode, policy polarization is much higher right now in the U.S. And what we're likely going to see is, even if we do ultimately avoid a crisis, there's going to be some brinkmanship in the lead up to it, and that's going to lead to some volatility, and that's justifying those moves. So I think that, you know, investors this time around should be paying attention to what happens in terms of the debt ceiling in the U.S. And like I said, that's going to lead to some volatility in equities, even if the limit is ultimately resolved.
And talking of volatility, Ruqaiya, we saw markets take a moment to understand what the SLOOS survey of loan officers, what that messaging was really all about yesterday. And it was really interesting to see, yes, there were some institutions that were dialing back the availability of credit to their borrowers, but there was also a really notable pullback in demand for credit at the time when we saw a lot of tension around the banking sector. So perhaps that makes sense. But what do you see as the sort of wider implications of a pullback in credit, either supply or demand in the United States?
Right, and remember, this has been going on before we even saw this March bank tumult. We've been seeing, you know, loan demand weaken. We've been seeing banks tightening lending standards even prior to that. So this is a continuation of this trend, and it's not really unexpected. On the one hand, we have the Fed continuing to tighten interest rates, and on the other hand, we are seeing this bank stress emerging. And so, you know, what we're likely to see as a result of this, even if the regional bank issues are resolved, is this continuing tightening of lending standards. That's going to be a drag on economic growth. And that's really what we're most concerned about over a cyclical horizon. And, you know, I think what's also interesting from this SLOOS that came out is that banks also expect this to continue throughout 2023 on the back of, you know, economic uncertainty, a deterioration in the economic environment. You know, so this is going to continue to be a story going forward. And you know, it just ultimately reflects the fact that, you know, the Fed has been tightening policy so much this year. So something is ultimately going to have to break, and this is what we're starting to see some cracks right now.
Well, when you talk about something having to break, at what point does that turn into an all-out recession? I think from a market's perspective, from an equities perspective, that earnings recession is in the rearview mirror. But if you look at it from an economic perspective, we've been warning about the R word for, I want to say, 2 years now. How long is this going to drag out?
Yeah, what's very interesting about the U.S. economy right now is we're seeing this divergence between the service sector and the manufacturing sector. So the service sectors, and that's like very clear from the PMIs that came out last week, service sector in the U.S. as well as in other places around the world, including China, those are doing still quite well. They're in expansionary territory, whereas manufacturing is in contraction. And so this pent-up demand for services is continuing to support the economy, and that's part of the reason why we're seeing things like strong labor market reports, even though we've been worried about recession, and indicators have been pointing to recession for quite a few months now. You know, ultimately, it's very difficult to time a recession, and there's, you know, no way of knowing exactly when that's going to happen. But it's looking increasingly likely over a 12-month horizon, and that's our base case for remaining cautious on equities over a 12-month horizon.
So what's the trade then? What are you, if you are going to be cautious on equities, what do you actually buy here in a decelerating economically growth environment? It feels like the go-to has always been buy big tech. Is that the mantra that people should still be following?
Yeah, I think the IT sector is probably poised to do better than other sectors, given the fact that it is a growth, it's relatively defensively skewed, it's high quality, so that should help protect the IT sector over the coming 12 months. In general, we're favoring defensive sectors over cyclical ones, like, for example, industrials, materials, those ones we don't really favor. And in terms of, just asset allocation, government bonds are poised to do better than equities overall. So that's what we would be recommending in terms of positioning.
And in terms of European assets, the euro fairly range bound at the moment, around the sort of 109, 110 level, Rukaya. But we've heard from some at the ECB that they think the ECB can keep hiking even as the Fed not only pauses, but maybe gets to the point where it cuts rates. I mean, could you see that divergence in policy coming to pass? And how strong would the euro get in that situation?
I mean, the message from the ECB that we got last week is that, Christine Lagarde, she point blank said that, interest rates, although she does believe they're at restrictive territory, they're not sufficiently restrictive, which signals that, the ECB is most likely going to hike again in June and maybe again in July as well. Now, if that does pan out, we would characterize that as a policy mistake. It would raise the risks of a policy mistake in the euro area, which would be negative for risk assets in the Eurozone, because ultimately inflation is a lagging indicator and wages are a lagging indicator. And these are really the indicators that the ECB has been focused on right now. Whereas if you take a look at credit conditions in the Euro area, not unlike in the US, we got the survey for the Eurozone last week, and that also showed that credit conditions continue to tighten in the Eurozone, which reflects the tightening in monetary policy that we've seen in the Eurozone. Now, having said that, we don't expect the Fed to cut interest rates this year unless the economy is in recession. And so in that sense, I think that there is scope for investors to dial back the pricing and the interest rates for the rest of this year. That shows that, the Fed is going to cut interest rates this year. And that could actually lead to some support for the dollar relative to the euro over the near term.
Okay, thanks so much, Rukaya. Good to speak to you. Rukaya Ibrahim of BCA Research with her thoughts on the markets. Coming up, we'll work out how politics affects the markets right now. Congressional leaders are meeting at the White House today to try to solve the debt limit stalemate. Can they? Up next, we will speak with Greg Valliere, Chief U.S. Policy Strategist at AGF Investments. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer Wednesday on Bloomberg.
I think it's ridiculous. It's always resolved, and not that it's 100% chance, but I think it gets resolved. I would suggest for those that are less concerned, similar to myself, that they buy a 1 month, 2 month Treasury bill at a much higher rate than they get with a longer term Treasury bill.
PIMCO co-founder Bill Gross there speaking with Bloomberg yesterday on the debt limit debate. His comments come as President Biden prepares to host House Speaker Kevin McCarthy, as well as other congressional leaders over at the White House today to try to resolve the impasse over the debt ceiling. Joining us now is Greg Vallier, AGF Investments Chief U.S. Policy Strategist. Greg, look, it looks like Wall Street, which for so long was brushing off the debt ceiling issue, is now starting to hold its breath. What are the odds we actually get some sort of deal after this meeting?
Zero. I don't think there's any chance there's a deal today. I think they could come out and say we're going to redouble our efforts, we're going to work harder, we're adamantly opposed to default. They might have some soothing rhetoric, but the idea of a deal, I got to tell you, I think that's weeks or months away before we actually do get a deal. I think they're going to have to kick the can down the road and extend this into the fall.
How is that possible, though, if we're talking about hitting the limit June 1st, I believe, if we do indeed go to the fall, as you say, what do the order of events look like? What do these next few months look like?
Well, the same as before, I think. Lots of rhetoric between both sides, lots of alarmist talk about what a default would do to our economy, a lot of stonewalling, and I think an awful lot of speculation about Kevin McCarthy. Does he have enough support among his troops? He's on a very, very short leash, and I think that he doesn't have a lot of flexibility to ease up on the plan they passed a couple of months ago.
I mean, are you looking at a short-term extension then, Greg? Is that what it looks like to get us to the fall? Is that what we have to factor in here? In which case, I'm trying to think whether the market puts this to one side until the fall and then revisits it.
Well, I think the stock market would. As we've seen in the last few days, Treasury yields have gone up. But I think the stock market would probably be happy to see this doesn't become a crisis until the fall. And that might give them an opportunity to actually get a decent deal. But this, to me, means that it increases the cynicism and the frustration in the markets that we've got to go through this for such a long time.
And you actually put quite a high percentage chance on a default, Greg. Talk us through your thinking there.
Yeah, I've been at 60-40 that we get a deal since the winter. I'm still comfortable at 60-40. 40 is high. I mean, that's a little nerve-wracking to think there's a 40% chance of a default. I think before we get there, there's going to be one last look at a lot of gimmicks, not just kicking the can. But I think they'll look at the 14th Amendment to the Constitution, which has a really intriguing sentence that claims that we have to pay our debts. They might even look at minting a $1 trillion coin. There's all sorts of regulatory action that could occur. So I think we've got to go through all of these gimmicks. And I would add, Congress is on vacation a lot. They're out for much of the rest of May. They're out for the second half of the summer. So there's not a lot of time. I think we get to Labor Day and then things really heat up.
Greg, I love that you mentioned that a good chunk of Congress will be on vacation, because now I'm wondering, in the meantime, as this is all sorted out, of course we're going to be on default watch, as you say. What about things like paying pensions, paying government salaries, funding for museums, the Smithsonian's, for example? How does that all play out?
Well, that's a big issue if we get to a drop-dead date and we don't get a deal, whether it's in June or whether it's in September. If there's no deal, then you have a lot of government spending frozen. And I think in particular, Social Security is going to be a big issue. I think the politicians are going to make it clear to senior citizens that they could be vulnerable, and that'll put pressure on Congress to do something.
when I talk to some investors about this, Greg, they describe it as fairly binary. You know, you ask, is there any point really in preparing for an outcome like a US debt default because of the impact that it would have? And they describe it as fairly binary, but the description you give is something a little more complicated than that, especially if some of the more creative, or you could call them gimmicks, as you suggest, if we go down any of those paths.
Oh, absolutely. I think it would be a bigger concern for the fixed income market. But let me just make this point. To my surprise, the stock market has not really been affected by this at all. The market has other things to worry about, Federal Reserve policy, things like that. But the markets, I think, still have a sanguine view that at the last minute, as we saw in 2011, we'll get a deal. I have a view that at the very last minute, if it looks like there'll be a default, the Fed would have to get involved. I think Jerome Powell would be aghast and very upset. He calls this a loathsome option. But in desperate times, you take desperate measures. And at the very last minute, I wouldn't be shocked to see the Fed get involved.
He did recently say, though, there's little they can do to protect the economy.
Say again?
There's little that they can do to protect the economy at the Fed. Jerome Powell said that at the press conference last time.
Yeah, and I think that the Fed knows that the implications of default are so horrible for global markets that the Fed would have to do something. Maybe they'd have to buy bonds that are imminently going to default. But that's way down the road. I think we probably wait until the fall before we get something that radical.
Greg, thank you so much for joining us. Greg Valliere of AGF Investments with his thoughts on the debt ceiling. Coming up later today, U.S. Representative Brad Sherman, a Democrat from California. That's a conversation we bring you at 1 p.m. New York time, 6 p.m. London. This is Big Bang.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Moment news breaks. No one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now, let's take a look at what is ahead today. Before the US market open, we will get Fox. The focus for that report will be the impact, of course, on Tucker Carlson's departure and Fox's settlement with Dominion Voting Systems. What does that do to the numbers? At 12 p.m. Eastern Time, New York Fed President John Williams will be speaking to the Economic Club of New York. Airbnb and Rivian are among the companies reporting after the bell. And today's main event, US President Joe Biden is scheduled to meet Speaker Kevin McCarthy and other congressional leaders to discuss the debt ceiling, although, as we were hearing from Greg Valliere, he doesn't expect a deal imminently then, Kriti, to come from this meeting. And I know that you're looking at some of the things that are moving more imminently in pre-market trade.
Yeah, on the macro front, everyone kind of staying a little bit frozen, to your point, Anna, but on the micro, a lot of movement. Palantir, for example, is one of the stocks that I'm watching this morning. PLTR for our radio audience is the ticker. Look, they came out with earnings yesterday after the bell, and they said their demand for AI is unprecedented. The share's moving about 19% in the pre-market. Anna, all they had to say was AI, that shot the stock up higher.
I mean, I was talking about a business here in Europe, Pearson, of a very different nature, but they were talking about AI and working that into their business, and yeah, lo and behold, that sent the stock higher as well. What about PayPal? We've had news flow around that one.
Yeah, PayPal's another major one. Look, they also came out with their earnings, and look, they beat them. You're already seeing this become a major theme where a lot of these stocks are beating their earnings. They even raised their profit outlook for 2023. Ordinarily, Anna, that would be a positive thing. Instead, the shares are down about 4% in the pre-market. They're saying that their margin outlook is actually coming in significantly weaker, so getting punished by the street there.
And the semiconductor devices business that is Skyworks, that seems to be making some news.
Yeah, Skyworks we know and love from being the Apple supply chain. It's one of those stories I love to see every time they have the iPhone demand story or a geopolitical story. Skyworks gets hit alongside Apple, along with likes of Cirrus, for example, or Qualcomm. So this is that chip maker that's down about 10%. Look, they matched Wall Street estimates, but they also missed their outlook. Now, look, this is a stock that's been under a lot of pressure since Apple announced they're going to go in-house for developing their chips. But Anna, for me, this is extra interesting because we like to look at the likes of Caterpillar or John Deere stateside as these global bellwethers. But I would say chip makers like Skyworks turning into more of a global bellwether. They actually warned about a little bit of headwinds when it comes to not the Apple iPhone, but the Android instead, and that's where they're seeing a few hiccups.
Yeah, talking of global bellwethers, we heard from Komatsu yesterday, in the same market as Caterpillar, of course, often seen as bellwethers for that part of the market, and they weren't all that positive on China, which is interesting, especially when you look at the where we saw the weak points in the Chinese export-import data overnight. It's been really interesting, though, the way that stocks have been pretty range-bound through the month of, well, certainly the latter part of April and into May. Then, Kriti, we've had maybe some positive earnings stories, or at least bearable earnings stories, in the face of negative expectations that have offset some of the concerns around the banking sector. Maybe stocks have been really quite surprisingly resilient through all of that.
They have, and it really all comes down to the E word, efficiency. And we heard it from the likes of Mark Zuckerberg, for example, saying this would be the year of efficiency and really rewarded by the stock market for it. And that's why the margin story is so important, because even though we're now talking not about bottom line growth, but top line growth, margins are still turning out to be the Achilles heels for a lot of these companies that are actually performing quite well.
Yeah, and it's all about some margin sustainability as well. We hear from some of our guests, not just what they can do now, but what they'll do in the future. That is it for Early Edition. Surveillance is ahead. They'll be hearing from Oppenheimer during the program. Lots to talk about as we continue coverage of the debt ceiling debate over in the United States and get ready for CPI data tomorrow. This is Bloomberg.
degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
We're in this very broken play, a world of a series of not just serious, but quite unique and rather unprecedented disruptions.
I don't think we necessarily set a new low, but we could arguably retest those existing lows at some time before the end of the year.
Right now, we have 5 cuts priced into Fed fund futures over the next 12 months. That's a lot.
The market is underpricing the risk of the Fed remaining on hold for the remainder of the year.
Unfortunately, I think a mild recession is the most likely outcome.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market a bit softer this morning on the S&P 500, negative by 0.3%. We're on PacWest Watch once again in the pre-market. That is down to about $5 a share in early trading. We're negative by more than 13% and barely squeezed together a day of gains in yesterday's session. Right now, $5.16. We'll come back to that in a moment, Bramo. We need to talk about the lead story later on this afternoon. 4 p.m. Eastern Time in the Oval Office, congressional leaders with the President of the United States.
And trying to dampen any expectations for that meeting ahead of time. We heard yesterday from Mitch McConnell. We heard yesterday from Democratic leaders, but in particular Republican leadership coming out and saying, we're not going to work miracles here. There's no magic bullet. And so basically saying, stop it with hoping we're going to resolve it today because it ain't going to happen.
There are other people in that room at 4 p.m. Eastern Time, but we all know it comes down to just 2 guys, right?
Correct.
They've got to sort it out.
And basically, at this point, this is the question. And Talib Singh of PGIM Fixed Income yesterday put it well, formerly of this administration, basically saying, at this point, politicians are looking for the markets to push their hand. They're waiting for the markets to freak out, have some massive sell-off, and then say, we had no choice. We had to have some sort of deal. The market's saying, we've seen this movie before. We don't want to do it. And so as a result, it's making it more likely that we reach the debt ceiling limit, that we actually pass it, that we enter default because there isn't this sort of pressure coming from markets. How perverse is that?
We're playing chicken with the S&P 500.
It's ridiculous.
It is ridiculous and very frustrating and very exhausting. And that's why a lot of people try not to pay attention to this. And I think the other reason as well, Lisa, they struggle to get an edge. What edge can you have around a story like this, go into a mess like this one later this June?
Absolutely none. And that is the problem. It is politics, and it is basically this game of chicken that we're playing, and we don't really know where the gravity really lies. What we will see later today is perhaps the nodes of some room for some sort of adjustment on either side, and whether President Biden comes to the table more sort of willing to negotiate, or basically saying a clean debt bill, clean debt limit, or nothing.
Have you got any confidence with these guys to sort this out before the X-date? Have you got any confidence in Chairman Powell? According to many of you, you don't. This is a Gallup poll released today showing 36% of U.S. adults say they have a great deal or a fair amount of confidence that the Federal Reserve Chairman would do or recommend the right thing for the economy. Lisa, 36%. We are talking record low stuff here.
Yeah, compared to 37% during her first year with the Fed in 2014. So very much a significant decline. I do wonder if this is a Jerome Powell issue or if this is an elected official issue, whether we're seeing in general a loss of confidence with all elected officials just more broadly. And you see that across the board with a decline in confidence that any party can deal with the economy correctly.
Did you not read the scripts that I distributed around the newsroom this morning?
Oh.
It's a Jay Powell issue.
Yes,
Get on the same page, Bramo. It's a Jay Powell issue.
Look, I think that it's important, though, because it means that it's going to become that much more perilous for them to keep rates high if unemployment rates go up. Basically, if you start to see an economy that materially weakens and there's a lack of confidence in Jay Powell to start with, it makes their job that much more challenging just going forward. So I take your point, and I do agree. I just was in this poll, you could see all of the leaders just basically have no confidence
It's pretty low.
whatsoever.
We talked about Biden's poll, the Washington Post ABC News poll that came out over the weekend. If you're wondering where TK is, he's reading the slews. He's still working his way through them. Bramo is going to be back with us tomorrow morning. What did you make of that?
I thought it was really interesting, not the decline or the tightening in the standards, but the demand side. That's what I find most interesting, because that tanked at the fastest pace going back to 2009. Is this a confidence issue in corporate suites, C-suites across America, or is this a confidence issue by banks that they're going to get the money back?
We're anticipating it's going to continue as well through the year ahead. We'll pick up on that story in just a moment. Just to get you up to speed on the price action, it's Tuesday morning. Good morning to you all just tuning in on TV and radio. This is what it looks like right now on the S&P 500. Negative 0.3%, barely put together a day of gains to kick things off on Monday. In the bond market, yields coming back about 3 basis points on a 10-year, 347.48. And hello, Bramo.
Wow.
Look at that. The euro, 109.82. We're negative 0.2%.
Fireworks over there. Honestly, it is interesting, though, that it's going in the direction that a lot of people weren't expecting, which is dollar strength. Today, the Fed speak that we get includes at 8:30 a.m. Eastern, Fed Governor Philip Jefferson. And then later this afternoon, New York Fed President John Williams. The Fed speak reignites throughout the week. Today, President Biden, as you were saying, 4 p.m. in Washington, D.C., is meeting with Republican leaders Kevin McCarthy and Mitch McConnell. Democratic leaders will also be there, Hakeem Jeffries and Chuck Schumer. They have already dampened expectations, and yet perhaps we'll get the contours of what some sort of deal might look like. And today, earnings continue. Just to give you a sense, we're more than 85% of the way through this earnings season. And today we have a slew of oil majors, Duke Energy, as well as aftermarket Occidental Petroleum. I'm very interested in some of the consumer discretionaries, which we get Airbnb, for example, after the bell, because our next guest pointed out that 3 sectors are showing double-digit earnings growth in this earnings season, including consumer discretionary, which I find fascinating at a time when people are talking about a potential recession.
John Stolfus joins us right now, the Chief Investment Strategist at Oppenheimer Asset Management. He is constructive on this equity market. John, Marko Kolanovic at JP Morgan is not. And this is what he had to say to start the week. If rate cuts happen this year, it will either be because of the onset of a recession or a significant crisis in financial markets. Marko went on to say the gap between the bond market, equity market, and the Fed is likely to close at the expense of equities. John, why do you think Marko's wrong?
Well, for one thing, I think when we look at the market seems to be very confident, both from the October low of last year on October 12th, as well as on a year-to-date basis. It seems to be very, very confident that the cyclicals are of interest, growthier value and garpier growth are of interest. Your best performing sectors on the year-to-date basis are communication services, 23.16% on my Bloomberg. Information technology up 22.7%. Consumer discretionary up 14.56%, all outperforming the S&P 500, which is up 7.78%. Your worst performers are energy, financial, and the Utes, negative 2.57%. As you all know, I've been in the market since 1983, so that's every boom, bust, and recovery cycle since then. And there's no doubt about it. We've got a situation here where we're coming up with this debt ceiling situation that is significant. But the interesting thing about that, in our view, is we believe it would be political suicide for anybody who takes the United States over the cliff into any kind of a default. You know, the last time that we had one of these that I remember we were headed to the, taking it to the limit with the politicians, I think it was Warren Buffett got on the financial, on a financial channel, and he said, you know, he said this would be the first time the U.S. would default in 230 years. This would be a highly offensive thing. I'm paraphrasing, but he said essentially, and all of a sudden, I don't, within 24 hours or so, as I recall, it was done. They came to an agreement. It was reported in a lot of corners around the market. Well, they kicked the can down the road, but guess what? We didn't default. Markets went up. We got through that.
Yeah.
And I think that's what the market is betting on. I think the market is also, and by the way, I understand what you're saying. Fed Chair Powell has a bit of difficulty in terms of his communication skills, ironically. I mean, but attorneys speak great to attorneys. That's part of his schooling. But sometimes when they speak to the general public, people don't understand them. But I think he's done, from having come from a position of being way behind the yield curve to now really having cut inflation just about in half with 9 cuts and most recently an additional 10. Let's see how that works. So far, so good. The economy is telling us plenty of jobs. Businesses, as you mentioned, Lisa, with those 3 sectors are showing resilience with double-digit earnings, okay? And others are waffling along a bit, you know, but you've got an earnings season that is not devastating in a highly challenging environment, which indicates that businesses, having gone through the financial crisis, having gone through the pandemic, having gone through the post-pandemic, all the supply chain disruptions, all the political unrest in Washington that we've been living, and the social problems in big cities, all of this, and they're still, you know, able to make money. And it's natural that earnings are going to decline some in a period like this.
Yeah.
But it looks like light of the tunnel is not a locomotive, but it's sunlight. But you got to run a gauntlet.
John, you're killing me.
There.
That's a 5-minute response to why is Marco wrong. Can you imagine if Marco's listening this morning?
What can I tell you? Well, you guys know
John,
me. You asked me a question. I want to give you a detail.
And understandable, you've been pent up as you listen to all of the bearish proclamations, and you're just trying to basically get your point across, which is that all of these things are just wrong. But I do wonder what you make of the fact that there's been such a huge decline in demand for loans, the confidence in the C-suite, how that pairs just quickly with the optimism that you see in consumer spending.
I think what we'd have to say is that the businesses are getting very, very cautious in here in the near term. I mean, there was one point last year where I think there was one poll that showed something like 98% of CEOs thought there was going to be a recession late last year, at the beginning of this year. Well, so far that hasn't happened, and we waffled through it. And I think what it is when they're concerned, they don't fool around. They tap down right away, but they're prepared to ramp up again. And with an economy that is not analog but is essentially digital, you can ramp up remarkably well. It doesn't mean you're perfect. You know, you can have all kinds of sluggishness moving ahead. I think we get moderate growth out of this thing, but on a relative basis, that's not so bad. You know, and we'll be away from free money, which is what really got us into this situation overall. It was the pandemic, politicians adding, both administrations, a lot of liquidity to the system on top of the Fed. And the Fed's taking all the blame, you know, which is very kind of them. But it's politicians, ultimately, it's the politicos. You know, when we vote, if we don't like what they do, we should get on the phone and call their offices and have 5 of our friends tell 5 of their friends to do the same, and then maybe we'll get somewhere politically. But
John, this turned into a public service announcement. I love it. We're totally on the same page. Get on the phone.
Exactly.
Get on the phone.
Call your representatives if you don't like
John,
them.
thanks for getting on the phone for us this morning. We appreciate it. John Stolf was there of Oppenheimer Asset Management. I love that. Fed's taking all the blame.
Yeah,
call your
so nice
politician.
of them.
Get on the phone. Tell 5 friends. Get them to tell 5 friends. Sounds like he's running for office.
I know, exactly.
It's amazing.
He's got a band.
In the next hour, Katie Kaminsky of Alpha Simplex. Looking forward to that conversation. Your equity market negative 0.3% from New York. This is Bloomberg.
Keeping you
up to date with news from around the world. With the first word, I'm Lisa Mateo. Senate Republican leader Mitch McConnell warns that he has no secret plan to solve the debt limit deadlock. Congressional leaders meet today with President Biden. McConnell says he told the president it was up to him and House Speaker Kevin McCarthy to find a solution. At the same time, McConnell predicts the two sides will reach a deal and avoid a default. Vladimir Putin vowed to pursue his invasion of Ukraine, accusing the Kremlin's enemies of seeking to dismember Russia. Putin spoke at the start of the annual military parade celebrating the Soviet victory in World War II. He said that a real war has been unleashed against the motherland. In China, more pressure on the economic recovery that's already been called into question. Export growth slowed last month to 8.5%. Meanwhile, imports plummeted almost 8%. Economists warn that the strong export figures aren't likely to last forever. Shipments are expected to drop this year. Aramco will introduce an additional dividend, potentially boosting payouts for Saudi Arabia's government by billions of dollars. It comes at a time when weaker oil prices are pushing the kingdom's budget into a deficit. Aramco says the new dividend will be between 50 to 70% of the company's annual free cash flow. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
from London and Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I think we could see continued stress in the banking system broadly, but very much at the lower end as we work through some of these COVID excesses. I'm not sure that we're out of the woods, but I do think that the big booms have probably been heard.
Great to hear from David Leibowitz there, the global market strategist at JP Morgan Asset Management. Kicking off your Tuesday morning, good morning, with your price action looking like this. Negatives by 0.36% on the S&P 500. Going into CPI tomorrow, PPI on Thursday, and a congressional leaders meeting with the President of the United States later on this afternoon, 4 p.m. Eastern Time in the Oval Office. Looking at the bond market at 348.24, yields lower by a couple of basis points. Crude breaking down just a touch, negative 0.7%, 72.65. Lisa, we haven't talked about the import data out of China. Chinese imports breaking down and pretty severely overnight looking at that information.
And this goes to something that we've been talking about. Has the recovery been entirely domestic with respect to domestic spending in China? How much is this actually going to trickle out to other economies? And this really does fly in the face of this idea that Japan and South Korea and some of the other regions are going to really see a massive spike up in economic activity as a result of China's reopening. Does that continue? And are we seeing that in oil?
Will Kennedy of Bloomberg joining us in about 30 minutes' time to have this conversation. Looking forward to that. Looking at PacWest and a pre-market, let's get those numbers on the screen for you. We look like this, $5 and about 20 cents in the pre-market at the moment. Yesterday at one point, that stock was up by about 30%. Those gains faded pretty hard going into the close, Lisa. Now, I think we're all on the same page here. Once you get a name down to this kind of level, there's not really that much point quoting the percentage point move because you're up or down 20% with some ease.
But what we've seen is a lack of a recovery more broadly at the regionals. Yes, you see fluctuations, but it really is still deeply depressed. And yesterday's sleuth, to quote Tom, the Senior Loan Officer Opinion Survey, raised questions about profitability more than anything else to me. Yes, you are seeing tighter credit conditions. You're not necessarily seeing some sort of credit crunch yet, but you are seeing a lack of a profitability proposition on the part of banks.
Sluice used to be this random thing that you'd talk about. You'd have to explain what it was. You'd come on air and you'd be like, yeah, so there is this survey that the Fed conducts of senior loan officers. They give their opinions on what's happening with loan demand and lending standards, and people would just be like, yeah, whatever. Then it moved markets yesterday. Well, remarkable.
We said that about the University of Michigan inflation survey and how much that was going to potentially influence things. We've said that about every economic indicator that's become the hot data point, one after another, that suddenly is the data dependency that's a roving target to find what that data is.
Mitch was always ridiculous. I don't know what Chair Powell was up to there. Gerard Cassidy joins us now, head of US Bank Equity Strategy and Large Cap Bank Analyst at RBC Capital Markets. Gerard, wonderful to hear from you again, sir. Can we start with the SLOOS, the Senior Loan Officer Opinion Survey? Gerard, what did you take from that yesterday?
Thank you, John, for having me on. And the survey had not really no major surprises. As you guys have been talking about, there was a tightening across the board in most lending sectors. The C&I, which is commercial and industrial loans, that tightening actually eased up a little bit. It was still tighter, but not as dramatic as it was 6 months ago. Commercial real estate still tighter, as well as on the consumer side. What's interesting, what really caught my attention was two things.
Lost the connection there. Wasn't sure what was happening there.
Yeah.
But they put me back on camera, so I assume that it's back to us.
I assume
Gerard Cassidy of RBC Capital Markets in London. I think we've lost the audio connection to him.
Yeah, I just stopped hearing him. So we will try to reestablish that connection and get back to him. But what he was talking about, I know he wrote a note about this, about how consumer credit has actually increased that in terms of demand and in terms of credit creation. Consumers are still borrowing, corporations not so much. And I wonder if this is just simply a result of who borrowed most during the pandemic. Corporations stocked up in credit, cheap credit. Consumers didn't so much. So at this point, you start to see a reversal in those trends, which really kind of are the push-pull that we see.
Some pushback from Andrea Hollenhorst on some of this yesterday, basically saying that this could have been a whole lot worse. Was this really worse than anticipated? Wasn't this just a continuation of the trend we saw in the previous slews?
I can't take you seriously. I can't take anyone seriously when they say sleuths after what Tom did yesterday. But I agree with you, and I did read that Hollenhorst idea. Basically, this is what Jerome Powell said, too. He said this is just a continuation of some of the credit tightening that we saw going back 6 months. To me, there is a shift. And to me, the fact that Gerard Cassidy is talking about how consumers seem to be continuing to borrow and companies don't raises this question. Are companies not borrowing because it's too expensive and they don't feel confident that they have the opportunities to invest? Or are they not borrowing because of some other reason, of something that they see in the economy that potentially is dangerous?
Gerard Cassidy joins us again from RBC Capital Markets and London. Hopefully they don't cut off the audio this time, Gerard. Let's continue that conversation on the slews. Lisa's mentioned the demand component of that report. Could you build on that, Gerard, whether that's something we should be somewhat worried about?
It's a good question, and John, as you pointed out, and Lisa indicated and mentioned, the demand was down not only for C&I loans, but for commercial real estate loans. Where we saw a slight uptick in demand was in the consumer side, but the commercial and commercial real estate loan demand continues to weaken as companies start to get a little more cautious about the outlook for their businesses, which is something that's very common at this point in the economic cycle.
Is that the right way to interpret it, Gerard? I mean, this is one of the questions as I was looking through the data. Was it that they are not confident about the future, or is it the companies already stocked up in cheap credit? They don't need that much more. They're actually getting plenty of revenues. Why take the expense of borrowing at these rates if they can just sit on their hands and sit it out? We saw this in some of the data in the first quarter GDP, that basically companies weren't making a move. They were actually being more cautious than consumers that keep spending. Is this data just a confirmation of that?
Lisa, that's a very good point. I would say it's a combination of those factors. One, as you pointed out, during 2020 and 2021, we had record DCM markets, and those companies have plenty of debt on their balance sheet and haven't used it all yet. But I would also say they are getting a little more cautious. And also the banks, as the banks enter this period, we have to remember, with rates being higher, it's more costly for people to borrow. So that's another factor on the commercial side. So it's a combination of those factors, as you pointed out.
Were you impressed by this, or basically mildly optimistic about the lack of credit tightening that some people were expecting to see in terms of a rapid decline in the willingness to lend?
I was, and I'm glad you mentioned that, because sometimes people get excited about the credit tightening. It's going to be a credit crunch. Not really. And the reason being, banks are in the business to lend, as we all know. And now they risk adjust that lending, and they may charge more for loans today, but they're not packing up their bags and not lending. They really have if they have real opportunities that are on a risk adjusted basis, it makes sense to lend, they will lend. Jamie Dimon points this out all the time on his earnings calls, that they're in the business to help their customers in good times and in more challenging times.
Lend less, though, might be the trajectory from here, though, Gerard. Wouldn't you agree?
Yeah, that's fair. Oh, definitely. You look at the loan growth, John, last year in the second half of 2022, it was double digits for the banking industry. We're forecasting this year we'll probably get 3 to 4% loan growth. So lending less is a very fair statement.
When you look at that report yesterday, just to put a bow on it, Gerard, would you say that's a feature of monetary policy and not a bug?
I think you're right that monetary policy certainly has influenced that. We know the Fed's balance sheet has grown so dramatically. Now they're in QT, and obviously they're shrinking that balance sheet, which is affecting the other side of the bank's balance sheets, which are deposits. So yes, I think you're right that is certainly a factor there.
Great to catch up, Gerard. Sorry about the technical problems a little bit earlier in the conversation.
Okay.
Thank you, sir. Out of London, Gerard Cassidy there of RBC Capital Markets. I promised you that note from Citi's Andrew Hollenhorst. This is what he had to say. Rather than a sharp credit crunch, the SLOOS is consistent with aggregate bank data showing a sustained, steady tightening of credit. That's his view.
Some people will read that and they'll say, Andrew Hollenhorst thinks that the market is completely underpricing the chance that the Fed's going to even raise rates further and hold them here for a longer period of time.
Andrew would tell you that.
Andrew would tell you that, yes. He would say that people have really overplayed the bank stress story, and this is just another example of it. Other people will read this data. I've read other reports that say this doesn't even include the credit tightening that we probably have seen as a result of what the SVB and First Republic. So it really is a tale of how you want to read the data. We get the data, and then people explain it the way they want to.
So how long do I need to wait for this quarter? Is that like in August? Is that when I get the report for this quarter?
It's late, yes.
Great.
Yeah, February was the one from
super
fourth
helpful.
Quarter. Yeah.
Super helpful. Thank you, Bramo. Equity futures on the S&P, negative 0.4%. Coming up on this program, Heidi Redeker of the Council on Foreign Relations on the debt ceiling debate. Congressional leaders in the Oval Office with the President of the United States, 4 p.m. Eastern Time. We'll count you down to that event through this morning. From New York, this is Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Live from New York City, welcome to the program on TV and radio. This is Bloomberg Surveillance. Just getting some data from a survey. The US small business sentiment from the NFIB survey falling in April to the lowest level in a decade. That one comes back in. But here's an important piece of it, loan availability. The survey suggests there was not a material change in credit conditions for small businesses in the month. In fact, the measure, according to our reporting here at Bloomberg, and thank you, Reed Pickett, for putting this together so quickly, the availability of loans actually improved somewhat. Now, bear in mind that it was at a decade low, Bramo, in March, but it didn't get worse. And I think a lot of people were looking to this survey for some information around that story. It didn't get worse, according to this.
What it does show is just this massive divergence that we see in what we see for the business environment for large companies and small companies, and this is just confirming it, which possibly is only exacerbated by regional banks withdrawing credit, but that's not the driver, and that's the interesting thing. There is something else going on that's leading to a decline in confidence.
Less than 1 in 5 firms said they're planning capital outlays. What do you make of that? They're not investing.
Well, so is this because they see some dark clouds in the horizon, or a recession coming? Is this something that they're seeing in the actual economy? Or is this just because